Well, welcome everyone. We want to thank everyone for attending our first ever Thompson Hine RIA Merger Conference. We are ecstatic that we've had such a wonderful turnout, both in person and online. Despite the government shutdown, thousands of canceled classes, I think we've adapted pretty well. So we're excited to have everybody here. Let me introduce myself first. My name is Ernie Badway, and I'm a partner in the Thompson Hine Business Litigation and Investment Management Groups. And my practice is primarily representing people in the financial services industry, such as registered investment advisors. And we are wonderful panels today. We're going to have 3 panels. And we're just so happy that everybody could be here in our New York office. We want to welcome everyone here today. Our program is designed frankly, to discuss. It's really an interactive program. We want you to tell us about what you're seeing literally on the front lines. We want you to ask questions. We want you to tell us the predicaments that you see. Of course, please change the names to protect the innocent, as they like to say, and everything. But that's the purpose of this conference here today. It's not for us to talk at you, but to talk with you. And what we want to be able to provide is sort of an outline in our 3 programs today about the compliance and regulatory issues that RIAs are facing in this very unsettled time in the industry, as you all know, as well as essentially, for lack of a better term, and I know you're probably all tired of hearing this, but succession planning. It's a good news and bad news. And one of the reasons why we wanted to have this conference was because we get a lot of questions from our clients about, and also people who are not our clients, but who we have business relationships with, who they're in great shape. You know, when I first started practicing let me back up a little bit. When I first started practicing about 30 years ago, not as old as Mark, but you know, okay, I can say that to him because, you know, it's fun. But when I first started practicing, if you made it to 50 years old in the securities industry, you were an old timer. You were a dinosaur, literally a dinosaur, because it was a youthful business. But because of a number of factors, including the fact that most people are living much longer and much healthier, okay, you know, and people in the succeeding generations are not gravitating towards the financial services generations as the prior generations. So what we are seeing is, 1, people wanting to continue to work, and 2, there really isn't that sort of bench strength coming up to sort of take over. Now, that's a good and a bad, all wrapped up in the same. And we've been dealing with these questions with a number of our clients, and we're going to probably continue to deal with those questions. So, you know, that's part of the impetus for this conference, and we're so happy that everybody can be here. Now, I want everybody to know, just from technical issues, okay, we're going to have some wonderful speakers. Our partners and colleagues in different offices, Daniel Philstrip and Shelby Harvey, will be joining us by Zoom. I will say this to you. They were supposed to be here in person, but unfortunately, when they're sitting on tarmacs and their flights get canceled 6 times, you know, you just got to throw up your hands and, you know, come up with an alternative plan. So, but they're going to be here. And just as importantly, if we don't answer your questions, or if you have an issue that you want to talk about, our people here at Thompson Hine are always willing and able to talk for 5 minutes. It's been my cardinal rule ever since I went into the private sector and practiced. That is, we don't charge for every 5-minute phone call. If you have a question, pick up the phone and call. I know lawyers get accused of that all the time. You know, that's why we're here. You know, we service your industry, and we want to know just as much as, you know, representing you. And, you know, if it ultimately results in a representation, wonderful. If it doesn't, we've made a great friend and a contact, and we're always going to be there. So please, 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 no shyness. know anything like that, just jump in and ask any questions or have any comments. And that includes all the people online. We have a wonderful tech person here today, Scott, and we're very happy about his presence, and he's a guru, and he'll be able to take care of all that stuff. Now, without further ado, I want to introduce my partner and my friend, Mark Miner. Mark has extensive experience. I'm going to let him talk about his own bio, and he will introduce his panel. And we are just happy, again, for everybody to be here, and I hope you have a wonderful time. Mark, turn it over to you. Oh, well, actually, one thing. We will be providing you, at the end of the presentation, we'll be emailing it to you, a copy of the PowerPoint presentation. So you will have that. Okay. Sorry, Mark. Yep. Go ahead.
Thank you very much, Ernie. Excited to be a moderator for this first panel today. See some old friends in the audience, and for those that haven't met yet today, I look forward to meeting you. I guess I am an old war horse, Ernie, but never too old to meet new friends, and excited to have a group here interested to discuss the issues that are important to what you are doing, and maybe to hear something from the front lines. I can't reiterate enough, as Ernie said, we hope that this will be an iterative process, and what's coming from the front lines is also coming from some of you in the audience. We have a great panel for this first panel. They all happen to be individuals who have come to us at the firm rather recently. We consider that a tremendous advantage because they bring a diversity of thought and ideas. Sometimes in our own roles and positions, we can get kind of stale and used to certain things. And so people that bring perspectives from the front line and bigger and a different perspective to help us tackle the things is what we're all looking for. Just a few moments on me. My name is Mark Miner. I have been with the firm going on 6 years now. I'm in the investment management and business litigation groups of Thompson Hine. I come to the firm by way of having my own regulatory consulting practice for 8 years. Before that, where I served as outsourced general counsel or chief compliance officer to broker-dealers, investment advisors, and asset managers. Prior to that, I was the securities administrator for the state of New York. And prior to that, the securities administrator of the state of New Jersey. I've done capital markets regulatory work in-house for the New York Stock Exchange and FINRA. And before that, garden variety prosecutor and criminal defense. So I spend about 30% of my time helping broker-dealers, investment advisors, and asset managers, various types of the funds, avoid the unfortunate regulatory gates of the alphabet soup of regulators. But if those issues should come, then I handle those matters vertically, along with some of my able partners here in New York that you'll hear from today. I'll give everybody an opportunity to do a brief introduction.
Sure, thanks, Mark. So my name is Kimberly Pack. I have been with Thompson Hine for about 9 months. I've been a career in-house lawyer and compliance professional. I sit in our Chicago office, so I made it in today because I came last week, so I had that foresight. I started my career off in a small broker-dealer and then went to a large financial services company where I did the internal FINRA testing. So I'm used to looking at people's work and issuing those reports, much to their chagrin, but helping the organization to be compliant and to continue to improve upon their policies. And so I am in our privacy and cybersecurity practice group, and so I'll be focusing on that today.
Thanks, Kim. So my name is Sahar Hamida. I'm actually coming from Los Angeles, so I'm sort of the West Coast representative on the investment management team. My whole career has been in the investment management realm, mostly in-house in different capacities. So I started at a larger firm in DC and subsequently went in-house for about 20 years, give or take, and as a chief compliance officer for a registered investment advisor and compliance officer for a duly registered firm, financial services firm, meaning investment advisor, and a broker-dealer firm. together. I most recently came from a real estate investment management firm that was mostly online, so it's more like a crowdfunding platform. So always have been in the investment management role, mostly in-house in just different capacities.
And joining us remotely, but certainly not last in our hearts, Daniel.
Thank you, Mark. So I'm Daniel Filstrup. I am counsel in our investment management group, also located in Chicago, but I did not have the same foresight that Kimberly had. So didn't make it into New York, but I'm happy to be able to join virtually. My practice focuses on both private and registered funds, both from a fund formation perspective as well as from a regulatory perspective. I also advise clients on a wide range of digital assets related matters.
Thank you, Daniel. So just a little bit to tell you what we're going to tell you. This first panel on compliance and transition, succession planning, exams, broker-dealer boundaries, and cybersecurity. This is for the compliance landscape for registered investment advisors, which has evolved rapidly in recent years, with regulators constantly redefining traditional oversight. Today's firms are navigating heightened SEC examinations, new succession planning requirements, increasing blurred lines between advisory and broker-dealer functions, and a growing array of business litigation and investment management practice groups, and also cybersecurity and data risk protection issues. I'm happy to be your moderator here today, and we'll cover these and hopefully other topics that pop up. Again, please feel free to ask questions. For those of you who are participating online, our firm has a chat box open. I will be monitoring that, and we can either take those questions in turn. Actually, I prefer to take those questions as they come up. And with that, let's get started. So we're going to start talking a little bit about succession planning and anti-assignment. For those of you who have worked in institutions that have either grown by acquisition or are maybe considering an exit for your companies or a division of your companies, there are lots of things that happen behind the scenes. I'm happy to have here one of my clients of the firm, and I'd served for several years as an outsourced chief compliance officer for Marstone, who was really an early entrant in the robo advising space. And very often, as some of you may know well, some days you're building as you're flying, and things are happening all over the institution. And then at some point, you become a more well-established institution, and if you're thinking about growing by acquisition or selling off, there's lots of things that may happen away from functions that are very segmented in parts of the business, but they're essential to know if you're in that market. So with succession and planning, if we're going to start with you, Daniel, let's start with what are some of the key considerations that RIAs should take into account when developing a succession plan?
Yeah, thanks, Mark. So, first, I think it's important to note that a succession plan is a key part of an advisor's fiduciary duties to its advisory clients. And there are a number of considerations to take into account when putting a succession plan together. Those include the regulatory overlay, which, in particular, does your succession plan trigger an assignment under the Advisors Act, which requires client consent? There's also internal dynamics. You want to consider whether your organization is on board with your succession plan, and if not, do you have a plan to deal with those risks as they arise? There's also, you'll also want to consider whether filings are required. If your succession plan results in a change of control of the advisor, that's likely going to require a prompt amendment to Form ADV. But even if it doesn't, there could be other aspects of Form ADV that need to be updated. You know, additionally, you want to consider if there are any other contractual obligations that get triggered. You know, specifically key person event provisions can often be triggered by a succession transaction. And then you want to also think about the effect of the succession plan on any asset manager mergers or investments that might be in the pipeline, because the succession plan is going to be a key diligence point that a prospective investor is going to look at.
Well, you said a mouthful. Let's talk a little bit about the client consent portion. We've probably both been a part of some planned successions, and you go back and look at the documents that talk about whether or not there is some affirmative consent or negative consent, and maybe confusion about the requirements. What do you look to first in trying to figure out what the obligations are of a company who's in that situation?
Yeah, so taking a step back, you know, as most of our attendees probably know, the Advisors Act requires that advisory agreements have a provision that requires client consent for any assignment as defined under the Advisors Act. Assignment under the Advisors Act includes change of control. But this can come up in maybe non-obvious scenarios. So for example, you know, control under the Advisors Act is defined as, there's a rebuttable presumption of control where an owner holds 25% or more of the advisor's voting interests. So that means even if you have, even if majority control of the advisor doesn't change, a 25% change, a change in a 25% owner could result in a change of control and assignment of the advisory agreement. And this can happen whether an advisor, whether an owner that is 25 at the 25% level drops below the 25% level, or it could happen when a new investor comes in and acquires a stake that's above the 25% level. Now, when that happens, it triggers the client consent provisions. It's important to look at what the contractual language says, and oftentimes the SEC staff will also look to the contractual language. Now, there's a bit of a gray area. So the most conservative approach is to build in negative consent mechanics into your agreements, and that means that you can go out and get consent from the clients, and if a client doesn't respond within a certain amount of time, you can deem that non-response to be affirmative consent to the transaction. However, there could be language in your contracts that don't allow for that. So then you have to actually go out and get affirmative written consent from the clients.
As someone who's been in the unenviable position of having to discuss with senior management that particular obligation, how have you addressed scenarios in which affirmative consent is required, but up-to-date information in books and records don't really allow for anything close to 100% response from the client?
Yeah, so there are a couple ways to deal with this. First of all, if you don't necessarily need 100% consent, right? So look to your contractual provisions. It might just require a majority in interest. So then you're only going out after a majority of your investors. Now, in the private fund space, you can also draft the assignment language to just require LPAC consent. So if you have explicitly stated that the LPAC can consent to an assignment transaction under the Advisors Act, then you actually only have to go out and get the LPAC consent, which can be much easier than trying to get all of your LPs to respond.
So can you talk a little bit about some of the legal and regulatory risks for failing to follow the rules of the road, as they are required in your contractual agreements?
Yeah, so and often especially the consent process comes down to kind of a risk shifting exercise, especially if you're bringing in, for example, if you're considering a merger or you're bringing in an investor, they'll often want to ensure that the process is compliant with the Advisors Act. So they're going to take a more conservative approach and could require you to get affirmative written consent from from your clients. So I would say that's one way. There are other options that you have, though, especially in succession planning, to maybe achieve your goals without triggering an assignment. So, for example, in the private funds space, maybe you can achieve the financial objectives of the succession by adjusting the economics at the GP level and not touch the provisions or the ownership of the advisor. So you can get creative and try to avoid the issue of assignment, but it does require some creative thinking and again, making sure everybody is on board with the succession plan.
Sure. Excellent points. And just know and understand that from the regulatory point of view, as someone who spent many years boiling the hot water, your obligation as a registered investment advisor, any registered entity, is to have a policy and procedure that's reasonably designed to prevent or detect the particular issue. It doesn't have to be perfect. So when the regulator is coming along and they see that something may not have been done exactly the way that they would envision it in the book, your counsel or chief compliance officer can point to why that practice or policy was reasonably designed to the scope and size and nature of your business, or as Daniel described, that you came up with attempted to come up with a creative solution that was going to put the largest number of people on notice and do that in a way that maximizes and ensures that they are protected. But you can always wring your hands for forever trying to come up with the perfect solution, and never let the perfect be the enemy of the good. We do have a question that's come in that says, can you talk about the consent differences, including timetable, between a stock acquisition, that being acquiring of an existing RIA, versus an asset acquisition where you're acquiring only the RIAs or the clients or business?
Yeah, great question. So there might be, typically if you're acquiring the stock of the RIA and you're using a negative consent process, the approach that has been widely accepted in the industry is that you give 45 days notice with a reminder after 15 days in order to get the consents back. Now, there are firms out there that will take a more aggressive approach and just do a one-time notice with a 30-day notice period. But again, it really depends on the risk appetite of the parties. For an asset deal, you can, I think, have that occur on an expedited timeline. But if you're truly acquiring all the assets of an RIA, I do think that there's still some risk that that's an assignment, and you're still going to want to think about how to comply with the Advisors Act's requirements. I don't know, Mark, if you have a thought on that.
No, those are all excellent points. I mean, this is going to be a threshold question if you are talking to counsel about a planned. Most people will use merger and parlance, but very often they mean something other than that. And so one of the first questions that you need to ascertain is, what is it that they intend to acquire? Are they going to acquire an investment advisor that is then going to be an affiliate or a subsidiary of an existing, or are you going to absorb it in total? Are you going to keep that institution and manage as a white label and sub-advisor of that institution? There are regulatory requirements that come along with that. Or is that the book, as was mentioned in the question, that would be a threshold corporate hill that you have to determine, because the approach, both for the acquisition and the exit, and all the schedules that go behind that document are very important. I always go back to, my goodness, it's probably 10 or 15-year-old guidance now. So IM guidance from 2016 that FINRA has issued about succession that I would encourage folks to review if they are under that scenario. Now, after you review it, you're going to say, hey, the parts of this are as clear as mud. And don't worry about being confused about that. But I know people who have gone back to staff and have asked for clarification probably from every paragraph and footnote of that. And they have been encouraged since then to do some updated guidance, which they have refused to do. What that has created is a series of no action letters that the SEC and FINRA have issued. Of course, those no action letters come with a very specific language at the beginning, and to say that this no action is only satisfies this very fact specific scenario before us, and you may not necessarily rely on its utility. But those who have practiced in the area have seen enough to say this looks a lot like this particular or that particular or no action. Is there some applicability that we can get from that?
And Mark, just one point of clarification, just in case there's some confusion. Even if that's not a change of control of the advisor, that, you know, if you acquire the advisory agreements of an existing advisor, that's a traditional assignment of the advisory agreement. So you're still triggering the assignment provisions if you're just acquiring the book, so to speak.
Excellent point. Excellent point. Well, if anybody had any other comments on that, or we can go on to our next section. Thank you, Daniel. So next, we'd like to cover a little bit about what happens in the examination process. Both SEC examination issues writ large, and particularly fee scrutiny, which seems to have some perennial effects. One of the questions that we'll always get is, in a change of administration, which types of things are emphasized and de-emphasized in different administrations. And it appears that there continues to be an intense interest in fee, treatment of fee, disclosure of fees in this current administration, and state securities regulators, which may take on their own view, even in the retreat of other federal actors. So, Sarah, we're going to turn to you. Let me start by asking, with the surge in exams that focus on fee billing and disclosures, what are some of the most common exam findings that you're seeing right now?
So, surprisingly, actually, a lot of the findings are based on just accuracy of fee calculations. It's quite shocking how many smaller firms, don't have their fee calculations automated, and so a lot of it is done manually. And with that comes, lack of backup disclosures. So when the examiner comes in, for example, when I was in-house, week into my job there, as the chief compliance officer, we would knock on the door. The SEC's examining, surprise examination, and I would say that out of 180 requests that we had for production, almost 35 to 40% were just focused on fees. So I think that that has been and always will be, I think, the most significant interest for the SEC when they do come in. So so fees, I would say the accuracy of calculations. I would also say backup documentation. When it comes to private funds, they're really scrutinizing allocation of fees. So are these fees being properly allocated between, say, the manager versus the fund versus any other affiliated entities that are involved? I would say that is the largest focus.
Can we drill down a little bit on the backup of calculations? About 9 years ago, we started to see a flurry of investigations and some regulatory actions that have now kind of culminated in some parts into what we refer to as the marketing rule and the definition of what is sufficient. I have found that there is frequently some confusion amongst the back offices about what is sufficient documentation about a decision on the determination of a fee, in addition to the fee calculations that are manual, which gives me agita. So,
Right.
so many different ways I'd like to talk about where you've seen that, like literal back of an envelope or something else. What have regulators found as sufficient support for the calculation and the fee determinations?
So I would say every single piece of document that's written down should be saved, because the regulators will dig down all the way from the very beginning, and even with respect to the marketing world, all the different modifications of marketing pieces that are discussing the fees, will be scrutinized, and sort of the evolution of how the fee calculations were done, or the evolution of how those fees or hypothetical examples are also portrayed, to the public or in their marketing materials. So I would say almost anything and everything. Just don't throw anything away.
Don't throw anything away. Yeah, that's sage advice. It reminds me of one of the last investigations I was involved in as a regulator, where there was a calculation of pricing, and the back office was running some models against a particular strategy, and the model was run 2 or 3 times with a new vending provider, and the portfolio manager text back to the folks who were doing the modeling, which they kind of retained a third party to manage that, and simply said that cannot be right. Now that was a document that lived on later, and the regulator, and there was actually multiple regulators in that instance, said that questioning of whether or not it was right wasn't necessarily the problem, but there were a series of meetings that happened after that, and a determination that this particular third-party modeling vendor did not have the background and expertise that they said that they should have to do the modeling on what was a rather complex strategy. And so, and they brought people in to talk about what happened in that instance, but it turned out that all the good things that they did were not memorialized.
Right.
And so they had no minutes of the meeting. There were emailed to suggest that there were meetings scheduled for that purpose. They ultimately brought in an institution who came up with different modeling. And so it looked a lot like they were just simply cherry picking the result, when in fact, had they had the models in the predecessor meeting that were kind of laid out on the table, and looked at the CV of the two institutions, basically they did all the things that you would want an institution to do if they have determined that particular vendor wasn't right. They were still hammered because they didn't have any books and records to demonstrate.
I really think that the examiners don't give you the benefit of the doubt if you don't have backup documentation. And especially when it comes to fees. I mean, I think everything needs to be documented. If possible, I would definitely allocate resources to automating as much of the fee calculations that can be done. But I know smaller firms tend to do a lot of that manually. And there's just, it's just the error happens, no matter how many human error and no matter how many, different checks and balances there are in place. And then just takes one incident of one minor fee calculation error to cause, just a flurry of issues. So I think fees, if you can allocate funds towards automation of fees and fee calculations, and I think that really puts the SEC at ease immediately, and you kind of can check that box off and move on to the next topic. Yes.
I have a question about that because I'm automated now. I've been for a few years, but prior to that, I just had an invoice where I said what the fee was, and then I literally put the calculation on the invoice, which is included on the quarterly review. That's documentation, correct?
Absolutely. If you put the calculation on the
I'd
invoice,
say you're multiplying this market value times this. Okay, got it.
And I don't even think that details needed to be put on the actual invoice, as long as the backup is there. And so I think the focus is like, when we come to disclosures and transparency of fee calculations, is just, even having a summary page of the different fees. But then, if the investor comes and asks for additional details, all of that is laid out somewhere that can be then provided. So
RIAs don't do that?
You'd be surprised.
Yes.
So as a follow-up to the question, if you outsource it, let's say to the custodian or to a firm like, these platforms, and rely on them to do the fee calculation, what is your liability as the RIA to prove that it's accurate?
So, there is a fiduciary, obligation, obviously, as a registered investment advisor on behalf of your investors. But I would say, first of all, there's the vendor due diligence initially. When you do hire on the third party, all of that due diligence needs to be documented, as well as, how did you, compare to other vendors in the industry and the reputation. So I think there's definitely, that is an obligation that has to be done and documented. The other thing is, I would say that, random audits, at least on a quarterly basis, is important.
Of the calculation.
Of the calculations, yes. So when I was in house, for example, every quarter I would just randomly pick a few different clients, pull their files, look at their invoices, and ensure that and literally manually calculate the invoices myself to see
Then
that.
just keep those as a memo.
Exactly. And then exactly that. And then documenting those internal audits, mini audits. Yeah.
But it's okay to outsource it.
Absolutely. But there is a need to have some sort of compliance oversight. Mm-hmm.
That's an excellent question. The regulator will tell you that you cannot obviate your fiduciary obligation by outsourcing it to a third party, but it does become a very effective defense to an allegation. And certainly where it often happens that in some dispute that there is a third party or an outside party that files an action on behalf of an investor or someone, then you can look to contractual provisions in which the third party vendor inoculates you against the liability. And so there's still value in that. I'd say that there are also additional protections for hiring a third party, because a private litigant is more likely to attack a negligence or gross negligence, where they will assert that the individual who's responsible didn't have the sophistication or expertise, and where you enlist a third party to help you with that, it helps very much in beating back that type of that assertion. Do you have another question? Okay.
So just a follow. So since most of the people here would be having fees on asset based market assets, what level of accuracy do the regulators look for? $, cent, $100?
I mean, 100% accuracy.
Yeah, I would say that.
Yeah.
But someone could price a market at 9 a.m. versus someone prices at 3:15.
Right. But all of,
what is considered a significant deviation?
I mean, I would,
Markets don't close at the same price all the time.
So let me add a kind of a complicating feature in there. The regulators do take into account the nature of the asset.
Okay.
And so where there are readily identifiable and a rich resource, and the appetite for a deviation is going to be very low. If you're pricing something that is, plain vanilla, there are lots of sources in the market for it. They would want you to be able to replicate down to like 0.01%, I think is the model's deviation has to be less than 0.01 when you run the model 3 times of a deviation using the same data's analysis. Now, if you're using something like a back of an envelope and you want to run that risk, but they have acknowledged that the complexity of the instrument and how it performs in the market, including volatility in the market, is a factor in determining the reasonableness of the efficiency and accuracy of the pricing model. But even internally, when a regulator comes in or some litigant comes in, see that, for the 3 times that you've done the calculation, you come up with a different number, then they're going to want to know how far away from the standard it was on the second and third iteration, or are there any changes in the data that was put in to that model, either for time and price or any strategy. And that's assuming that there aren't multi-legs to the strategy. Anytime you have any multiple legs to a strategy, then you're going to have to perform that for each of the sections and to justify your fee structure or your pricing structure.
My question is small fund considerations. You mentioned the manual calculations. The SEC Commissioner Hester Pierce spoke about streamlining and thinking creatively about lowering barriers to entry and small fund considerations. Is that something that you've thought about? And
lowering the barrier in terms of the minimums.
The compliance burden,
Absolutely.
Small fund versus a large
Right.
fund.
So you're just so I understand the question, you're asking if that
You mentioned manual calculations for
absolutely.
small funds.
Right.
Perhaps a less a smaller fund that has less resources.
Absolutely.
How would you, as a chief compliance officer, would you look at that any differently?
So I wouldn't. I would say as a chief compliance officer, I would just be more. There would be more oversight if it's not automated. So maybe doing internal audits on a monthly basis versus a quarterly basis. I would make sure that the documentation is very organized such that it's producible in perfect form at any point if the SEC shows up. Again, we're dealing with fees here and the protection of investors, so the regulators are going to, definitely want everything to be perfect, really, if you're going to be calculating manually. And it's not uncommon, and so it's just ensuring that all of your backup for the calculations is documented and saved somewhere.
I guess that's an excellent point. I would add as an encouraging note that in the last Trump administration, they really emboldened the section on advice specific to small advisors. And in speeches as recent as 3 weeks ago, Hester Pierce reiterated the need for changes in the regulatory scheme as it applies to small advisors. Now, there's been some discussion about what the definition of a small advisor is. There have been temporal elements before where they said you could be sophisticated and graduated out of that because you've been in the business for 10 years, although you are $100 million, which is the definition of small advisor. And assets under management, there have been approaches where they've put a dollar valuation on that. There have been suggestions where there just is some relief from some attention or action. But I think the upshot is that the current administration seems very exercised on revisiting some barriers to entry and some, I wouldn't say exemptions from action, but consequences of a failure to be 100% accurate or as timely in the reporting as some other larger market participants would have. I don't know what all of those are going to look like. Just know that it sounds like very much there's a sympathetic audience right now.
But Mark, to put a fine point on what you're saying, the SEC is famous for saying, you know better. You know, I've been in Wells meetings with people where the SEC staff has turned and said, you know better. You know, even when you're like, you may have assets under management of less than $100 million, they'll turn to you and say, you've been in the business a long time. What we're saying to you is not new. So that pervades a lot of what this, about how they operate.
Yeah, I feel like there's not a lot of forgiveness, especially when it comes to fees.
I have a war story. I did get subject to a preliminary audit. They did look at my fees. They probably had a very young SEC examiner look at it. She used an Excel spreadsheet. The calculations were incorrect. Across my accounts, I have about 50 million under management. She found $80 difference in total. And she calculated it wrong. And we had a little bit of a struggle getting them to, fill.
Wow.
So, your comments about being 100% are probably accurate. Although I have to say the SEC did not exactly cover themselves in glory. They also questioned my outside billing service. The young analyst claimed she never heard of it. They represent 900 RIAs. They had represented 900 RIAs. So, it's luck of the draw too. Right?
That's a horrible story, but unfortunately not that uncommon. For those of you who are fans of the Thompson Hine series, you'll know that just a week ago, we had a whole presentation that discussed the anniversary of Madoff. And one of the things that came out of the Madoff investigation, because I was someone who was on those investigations, that factored into how some activity was able to persist for so long was the youth and inexperience of the examiners who came in. So that it can inure to the benefit or the detriment of the participants. But I've certainly seen regulatory inexperience kind of wreak havoc on what should be some rather routine examination questions. And so, sorry you went through
I had to bite my tongue and not say, where were you on Madoff? But luckily, my better judgment prevented me from doing that.
Well, sometimes it's better to have the client to say it than the lawyer. So
I let my attorney talk.
Thank God.
Yeah. Question?
Thanks for being here, guys. I just want to highlight your comment on using technology too. I think that makes a lot of sense. I think too that as cumbersome as it might be, having someone just checking every invoice too, like I know it's annoying, it's kind of a pain. I've seen some firms do like junior advisors, I've seen back office. And I think just clients in general have more questions about fees. They want to understand, especially if they come from wirehouse, broker dealer, they really want to understand, like, what am I being charged? And if your junior advisors are checking the calcs, clients in Florida in the winter, like we didn't have the right address change, that wasn't added, or we opened a new account, but it's a cash reserve, we're not billing on it, or like the pro rata calc for IRAs is wrong. Like these things, the software, as good as software can be, it's going to miss stuff, right? Mm-hmm. It's going to streamline things, but I think that there can be a benefit having someone still look at every single voice. So like if you were in-house CCO, you're doing your check, you're not going to see any issues in that case, and then documenting can be good because client might call and be like, walk me through this invoice. And if you're going to post an invoice to your client portal, who's checked to see when they last logged on to the portal? They probably haven't logged on, right? And so do they even see it? And there's a difference between like what's regulatorily required and what like is a good experience for the client.
Absolutely. And so, one of the things that I implemented was, just obviously a fee summary sheet of what needs to be provided to a client, but then also, sophisticated clients do pick up the phone and call and ask for more detail. And, having something already drawn up that they can just share with the client, I think has been very helpful. Again, it comes back down to transparency, just being very transparent.
Before we move on from this topic, is there anything that you have seen unique to institutions that are duly registered, BDIA, where some compliance or regulatory questions kind of fall through the cracks, where that obligation belongs in, and how do you control for that?
So I was at Beller Investment Advisors, which is, they have a affiliated broker dealer, and it's a high net worth registered investment advisor, and it was the two of us managing the compliance for both the broker dealer and the RIA. I would say that organization is key when you have a duly registered firm, because you have FINRA that you have to speak to, and then you also have the SEC. And although a lot of the regulatory rules overlap, or fiduciary duties under the RIA rules versus best interest under the FINRA rules are very similar. When the regulators are coming in, they are specifically looking to see that both paths are separately organized. If it's a smaller firm and you do have one compliance or two compliance officers who oversee the whole, both sex, just making sure that when the officer's wearing their RIA hat, that's being documented as the RIA work versus the BD. So I think a lot of it is just really documentation, clarity, systems in place, continuous auditing and monitoring, and that's what I would say. Yeah. In terms, it's more often than not, firms they are messy in some ways when it comes to duly registered firms, because it's hard. There is a lot of overlap. So.
Thank you.
And especially when there's a client, in terms of, are you charging fees because the client's interested, or is this a broker dealer client because the client's interested in just purchasing a product or investing in a product, or is this ongoing investment advice in which they would fall under the registered investment advisor umbrella?
Thank you. And those are very important. We're coming up on probably almost 20 years now after the SEC announced that it's generally disfavored to have dual hatting of your chief compliance officer and your general counsel position. Now, with lots of small institutions, it becomes a necessary evil, but you really need to know when you have one hat on and when you have another, and that you are documenting when you're acting as one or the other, and at least could have outside counsel weigh in on the questions that are uniquely something that fit into the general counsel or legal sphere.
And one thing I just wanted to quickly note is that when you are doing these mini audits in-house, it's okay if there are violations, and those need to be documented. Actually, I remember an examiner coming in and he said, if we ask for a violation log and there isn't one, or there's nothing on the violation log, then we know this is not a firm that's compliant automatically, because no firm is perfect. I think it's more about the culture of compliance.
Right. And if you had an exam, you'll know that it's almost impossible to come out of it without some deficiency for you to work on the next time and do better. Well, Ernie's point about when you know better, you need to do better, made me immediately think of where I get that question most. One of the places I get the most of the past couple of years, and that's with cyber. So it's a perfect time to turn to Kimberly to talk about this topic. There are so frequently these issues with respect to integrity of data that's become its own subspecialty. So on the issue of cybersecurity and privacy and vendor risk, Kimberly, what are the minimum standards that you believe RIAs, regardless of size, should now meet?
Very, very, very minimum is to have the written policies and procedures. Everyone should have at minimum an incident response plan. And these plans, sometimes I've seen it where they purchase them, they don't update them at all. That does not work. When you open it up and it still has fill in the blank and you still haven't filled in the blank, does not work. When you have an incident response plan that you never look at again, when you treat it as a one and done, and maybe you did fill it out completely 5 years ago, none of those people work there anymore, they have different titles. So one of the things is to really be diligent around not only just having the documentation, but refreshing it, looking at it. Is it appropriate? Are the right people in there, the right contacts? So that's super important, just having that plan. And then I think people should go through the plan. I think one of the things that happens is we're too small, and these threat actors are equal opportunity in like the realest sense. They are looking for vulnerabilities across every industry, every size, They're going after municipalities, big companies, and they are very diligent around finding vulnerabilities. And we all, even if you're small, you have a network, you have email, they get in through Microsoft, they get in a lot of different ways. And so we all have to be really diligent. So having the plan, going through the plan, updating the plan, doing the tabletop, even if it's small, even if it's you and the secretary, right? Or like, it really is helpful to know what the plans are. I think also assessing your risks, right? What are your risks? What's your, what do you have? Are you going to be insured or not insured? I know single person RIAs that do get cyber insurance. Some organizations don't, and you should know why you have that. You should know what your money looks like if you were to have incidents. What would that look like for you to be able to pay, for you to be able to send out breach notifications? What would that look like? And whether you should try to pursue cyber insurance. And cyber insurance is a big decision. And so I understand those who are self-insured, because you're going to pay for it. Someone's going to pay for the things that need to happen. So some people are like, I don't have insurance. You're self-insured, because when it goes down, you will be paying for these things yourself, and you'll have to find that money. But the big thing about cyber insurance now is that the insurance companies have a lot of data. They have a lot of, how insurance companies operate. They mitigate risk. They don't want to pay them out. And when they are and they do pay out on cyber insurance. So when you get it, it's because you have proven a lot to them. So if you don't have good data hygiene, if you don't have written policy and procedures, it would be very difficult for you to actually procure insurance in this space. And so that's one of the things that I have noticed with those entities that are insured. They have better practices around written procedures, tabletops. They have better risk mitigation plans and strategies, because that is required for you to get insurance these days. And you have to keep it up, because these policies are only for a year. There are no multi-year cyber insurance policies. And so that means every year you would be going back and restarting that you do have this good hygiene, that you do have these good practices in place. So I think, again, the plans are good. Doing tabletop exercises, and just being prepared. And then internally, I think one of the biggest things is you being your own threat actors. How do you do passwords? There are still some entities that share passwords. There's still entities that might not want to pay for multiple licenses for certain things. Like, there's a lot of reasons why people might do that. But I would advise against that. So you really not being your own worst enemy around how you document things, how you password protect things, how you secure things, how you might try to do shared usernames and access like that. These are things that you should not do. We should make them as strong as possible. And so that's the bottom line. At least have written policies and procedures, which should include an incident response plan that you are keeping up to date. Repetition, I would say a zillion times. So I'll probably say that the whole 10 minutes I have that. Have a plan, know your plan, update the plan, and don't think you're exempt from your own internal mistakes. So having your teams know about cybersecurity, be thoughtful around it, offer some training, even if it's 20 minutes, even if it's really practical, depending on how many people working there, you should absolutely be using external folks for phishing, because those things work. Phishing works, we've seen it. And the phishing that happens now is so sophisticated. They may be inside of the account of someone you're engaging with. We see this. And then they will intercept the conversation, and you didn't notice because it's a spoofed email that's very close to the right email, and you were already in conversation. They didn't miss a beat, and now you are engaging with a threat actor, and they do things like get money and get you to send the payment options and things like that. So these things aren't just television. These things are really effective, and people are falling prey to them every day.
Sure. About cyber insurance. Bernie's not going to want to hear this, but the last time I looked at it, you had to be plugged in to your router. You could not use Wi-Fi. Is that still a requirement?
No.
Okay.
Because we use Wi-Fi every day. So yeah, and it might.
Last time I was going to get it, literally, if you didn't commit to plugging in as opposed to using Wi-Fi, you couldn't get the insurance.
No, I think things have certainly changed. Most people are using Wi-Fi. It's yes, secure Wi-Fi. Like we have plans where we don't use, public ones. You want to be careful around public ones. But yeah, people are using Wi-Fi and getting insurance.
They're getting insurance.
Yes, they are getting insurance. How long ago was
I don't know,
that?
5 years ago? I don't know.
Just 5 years. I wonder what carrier that was. Oh, we could talk offline about that because that seems very specific. That maybe that carrier is extremely, extremely risk averse. So it probably wasn't the carrier for you.
Got
Yeah,
it.
I was gonna say, Kimberly, when I was in house, there was a lot of, we went through ransom threats, and just something as simple as like verbal confirmations when sending out money saved us, I don't know how many times, so. Yes.
So these are all fascinating topics, and they're really, maybe AI is the only area that's moving faster, like with the headlines that I'm trying to keep up with the impact. Let me drill down a little bit about cyber insurance. I think that topic for investment advisory clients has grown and changed so much. Right? Just a few years ago, it was sufficient to say you ought to think about cyber insurance, right? And now there could be 2 pages of different things that you could be covered for, and some are very basic, and pricing variations depending on what you want to be covered for. Are you seeing lots of changes in advising clients? I've seen coverage that is basically just for intrusion, others that will cover some testing, forensic examinations in the event, which is now, I think, an obligation to know what's happened. So I couldn't see not being covered for that, but I have seen that. Ransomware and how it's defined and limitations on that, both in response and when you pay out, and things that might limit or violate the coverage. And so I have seen VPN or failure to operate on specific networks in violating certain provisions of the insurance. And now you can get discounts like good driver insurance, right? If you're doing things like, I've seen phishing testing, like do you do phishing testing? Do you do firm-wide training of your employees? That will reduce the premiums. But of course, you have to do that. And it's almost as fast as I can, the changes are happening almost as fast as I can think of them. Like when I need that expertise, I can call somebody like Kimberly. Have you seen this change or in the policies? But what evolution have you seen in the cyber insurance itself?
I think it's worth using a broker. I think when individuals who don't understand insurance try to go it alone, I think they undercut themselves because they don't understand the risk. They don't understand the kind of coverages that's out there, what's been negotiated for other people. And so I do think outside of, I think using service providers are helpful. And I think for insurance, I think using a broker can be very helpful for you to get the right policy that covers your biggest risk. And some of these policies cover, not just business interruption, but they also may cover your SEPA claim. So there are a lot of lawsuits that's come out around wiretapping laws based on your cookies on your website. Some policies, cover that. So are your policies covering cybersecurity stuff and also privacy litigation outside of just the breach? And so these are things that people might not even be thinking about, but anybody who has a website is susceptible to that cost and expense because they are also just blanketing and going to everybody's websites and seeing what cookies might be on there. And so I think, again, using a broker, understanding what's out there, what your needs are. Some people want to just worry about business interruption or maybe you know that you want to be covered if there are a breach because it does get very expensive to be able to defend. And I will tell you with these reporting laws, soon as you report, you get a lawsuit. You could have done everything right, best you could. You're going to still have to defend that lawsuit. I mean, we've seen it soon as they did that obligatory 4-day, it was a material incident. The lawsuits come, they are scanning the places where you're reporting, right? If you have a ransomware attack and the ransom threat actor and part of their threat is we're not going to let out the information. This is from real experience. We're not going to share the information right now, but we'll drop the name of who we've attacked. Just based on them dropping the name, lawsuits came. And they're like, and part of the complaint said, you didn't give us notice. We're still in the 20 days. We're still trying to figure out what actually happened. And we already have lawsuits filed. Like, that's how quick the plaintiffs bar are. They, you know, they are monitoring not only filings, but also the web things where threat actors speak and talk and make announcements. So they are tracing and tracking those things too. And as soon as an entity's name is dropped, those actions start happening. So I think using a broker, understanding what's out there, and getting it really tailored for your risk and your risk appetite, I think is really key.
I think we could probably do a whole separate panel on responding to incidents. So I see we're coming up on time.
Yeah, we are.
Yeah. So let me just close this out by giving each of you an opportunity to say maybe one thing that you might think is a regulatory or enforcement item that RIA should be looking for. This is our crystal ball moment. I'll start with you, Daniel.
Great. So, you know, one thing that I think is really critical is AI. And I think we're seeing increased implementation of AI tools in investment advisor operations. And, you know, while the SEC withdrew their AI conflicts of interest rule, I do still think it raises fiduciary duty questions among a whole host of issues. And so, you know, I would say keep an eye out for AI regulation, and in particular, you know, how it relates to fiduciary duties of investment advisors.
Okay. Yeah.
So just going back to cyber really quickly, I was going to say the one thing that we did in-house, implemented everywhere I went, was to hire third parties to do penetration testing, because I think that has been really helpful when it comes to not only just ensuring that the firm is protected, but also for regulatory purposes and visibility. And so I'm going to leave it with that, since that was my one point.
Yeah, and not to just keep harping on insurance, but it's very helpful. They do have some services. So once you have it, there are some preventative services, some practice. So there's other things you can use outside of just incident response that's included in that. For me, as I said 5 times already, is the policies and procedures written and up to date. And then that third-party vendor management. Third parties are a big source of cybersecurity issues, particularly around business interruption. When they go down, what's the impact on you? If all of your data is in this one tool, this one software, if something goes down, what happens? So just being thoughtful around your third party and vendor risk management as well.
Thank you. Well, in case you weren't frightened enough, for those of you who are responsible for cyber, just know that within the past week, there was an attack by an organization called CLOP. And there were enough breadcrumbs in there for intrepid investigators to figure out who was responsible or behind it, just based on tracing the trail of IP addresses. So when a regulator comes, they're going to say you knew or should have known, and you should have done better. But thank everybody for this insightful discussion. And this concludes our first panel. Are there any other questions before we move on? Okay.
Don't worry, there's going to be a lot of opportunity. We're going to have a little networking session and everything, and Kimberly and Sahir are going to be here. Please, just want to thank all 3 of you, Mark, Kimberly, and Sahir. It's funny, when Kimberly was talking about like all these like things that one needs to do, it reminded me of how much I actually love biometrics as a way of doing it. But of course, this weekend on one of the cable channels, they did their James Bond marathon. And I came across, I think it was called GoldenEye, where that biometrics may have a little problem. And any James Bond fan knows what that scene was when you don't want to use that. But that being said, thanks so much to this panel. And if we could get the other panel to come up. I know, Mark, you're just switching down. And don't worry, we're all going to be here. So if you have any questions that you want to ask, please do so. All right, everyone. Our next panel is going to be talking about the litigation and enforcement hot topics as they relate to RIAs. You know, unfortunately, you know, even with the change in administrations, it appears that litigation and securities enforcement actions are still coming fast and furiously against RIAs and items. Now, it's interesting. We're going to see, I know that on the commission's docket, there are a number of settlement agreements currently with RIAs. It's going to be interesting to see what happens to them after the shutdown. And I know that there are a number of investigations that we're working on that have kind of been shuttered because of the shutdown. And we'll see how they start up again. But this is sort of like the time we wanted to put this right in the middle to like sort of ease you into it. You know, if you follow everything Mark and Kimberly and Sahir said to you on the first panel, you won't have to worry about Brian, Rich, or Mark again. So let's hope that's the case. But without further ado, I want to introduce my partner, Brian Lancio, who is going to be the moderator for this session. Brian, why don't you take it away and introduce the panel?
Thank you. Thank you very much, Ernie. I appreciate that. And thank you all for being here today. You know, litigation enforcement activity in the RIA space, it's always a hot topic. There's always a lot going on. And as Ernie said, even with the change in the administration and the shutdown, there's still a lot of interesting topics that we can explore. We heard about some of them in the earlier panel: fee issues, cybersecurity, preparedness, conflicts of interest, the marketing rule, and things of that nature. And against this backdrop, as technology becomes more and more prevalent, as clients are becoming more sophisticated, it's interesting to see where claims are headed in both the private litigation sector and in the enforcement activity. So, you know, without further ado, you met Mark earlier today on the previous panel, and this is our partner, Rich DeBerry. You know, I want to start off by maybe contradicting the first bullet on our very beautiful slides up there about heightened SEC scrutiny. I think there's some interesting statistics that have come out for fiscal year 2025. So that covers the end of the prior administration and the beginning of the new administration, the first 3 quarters of 2025 calendar year. There are only 45 enforcement actions in fiscal year 2025 by the SEC. That's about half of the 98 that came in the year prior, and only 10 of those were initiated after the administration turned over. So if you think that there is some sort of a slowdown or you know, a lack of enforcement, the numbers at least suggest that as of right now, the administration is not overly active, and I'm sure the shutdown isn't helping them with that. But they are still pursuing cases. They have continued to keep the legacy cases from the prior administration, and have pursued new cases mainly focused on fraud, misleading practices, unfair practices, etc. By contrast, I'll give you some numbers from state regulators in a report that came out just a few weeks ago from the North American Securities Administrators. And they reported that in 2024, so there's some overlap, but it's not quite the same time period. But in 2024, state regulators initiated 471 investigations against investment advisors and brought over 100 enforcement actions against investment advisors and investment advisor representatives. So where the SEC is down, state regulators seem to be picking up the ball. But I think, you know, that's a perfect segue to see what our panel thinks about that. So Mark, Rich, what do you guys see as significant drivers of RIA-related litigation and enforcement activity for 2025?
Before we give hi everybody. Before we give some of these drivers, just in defense of our slide here and the veracity of that statement, maybe the SEC scrutiny is still heightened, but everybody is, because of lectures like ours and everybody trying to instill a culture of compliance, even after the scrutiny, maybe there is a lot of compliance and no need to bring on new enforcement action. So maybe the scrutiny is up, but actually you people and the compliance professionals out there are doing their jobs, and the SEC is being satisfied with what they're seeing. Unlike some of the states, which Brian points out, the activity is certainly up. So maybe there's a way to harmonize Brian's statistics with what's written up there.
So just trying to conceptualize this and not to minimize any of the actions, right? So you threw out a lot of numbers, but what's that as a percentage, right? So how many, are they investigating 1% of RIAs? I mean, it doesn't, in the grand scheme of things, this doesn't sound, I would have expected larger numbers. When you say 400 something across the states, that sounds small.
No, and that's an excellent point because as this group knows maybe more than most, there's been a proliferation of RIAs even as compared to FINRA registered representative or broker dealers. So as a percentage, we could say that federal enforcement actions and litigations and investigations have decreased year over year, even just as that number, as compared to I don't have the statistic on hand, but maybe ChatGPT would tell us if we could believe it, how many more RIAs there are year over year.
Are we allowed to use that?
No, I'm not. How many RIAs there are year over year, even within the same year, it's probably exponentially larger, while the enforcement actions actually have been halved, I think, is what Brian's numbers indicate, as especially as for new enforcement actions from the new administration from the turn of the year as opposed to prior, which have been carryovers. So that's an excellent point. So as a percentage, it's probably quartile, who knows, as compared to the amount of new RAs that have been formed, or even as they've consolidated and gotten bigger over the last couple of years.
And it is worth noting too that even in the state statistics, those are down from the prior year as well. So there's still an overall downward trend.
As we're looking at trends, one reason for this, and we're going to get to this topic a lot more later, I said more on the litigation end. We work, as this team here works on regulatory compliance and response and defense on the front end and the compliance side as well, but also for private litigation and for enforcement litigation from a state, a regulatory body, or the federal government. So as we've said here, what we've seen is the bull markets generally help decrease the number of enforcement actions and the number of private litigations. I don't know if the 2023 and 2024 market success has, bespoke some of these numbers that we're hearing here on some of the new investigations or not. But usually in downturns and in bear markets is when you get the customers calling, is when you get the regulatory chasing of the customer complaints and issues that are raised organically when people see their balance sheets and get their account statements at year end and they don't like what they see. That usually fosters more investigations than in good times when it's just a fight over who's getting the money and the allocation and the commission splits, which is something you'll hear about a lot about here, is divvying up the money and the allocations and being disclosing that and being upfront and transparent with clients in the good times. And it'll be a little different when and if there's a bear market turn, what the SEC will be looking at and what the customer complaints will drive at.
I think we had a question.
I'm sorry, I have to ask a kindergarten question. Could you explain the differences between a deficiency letter, an examination, and enforcement? It's really basic, I apologize, but a couple of people here might be interested.
Sure. So an SEC registered firm should expect within 2 years of its launch an initial exam, right? And that initial exam is basically to level set the operations that you've set up. I think it's a bit unfair to issue deficiencies, but even after initial exam, they do indicate things that are not operating as they see them within the normal requirements of an investment advisor. That, because I have led examination staff, I can tell you that though that checklist of what you're looking for is a pretty bare bones review. You don't have too much of a history of your institution. And so almost like a building inspector, they want to come in and say, do you have windows? Do you have plumbing? Does it run? Do you have electricity? Do you have the basic things? And at the same time, they're getting information about your business operation that would inform it on what they may need to think about in terms of risk to the investing public the next time they come. Even though it's very basic, there will be a list of things that they are finding as technical deficiencies. Well, actually, regulator hates for you to use technical deficiencies in the normal operations. There'll very often be things like required books and records or processes that you are required to do on an annual basis. Maybe, as we talked about in the last panel, you're doing them, but there's no record for that. Okay, so yeah, you're doing an annual training, but you didn't have a sign-in sheet to prove that was there. It could be something as simple as that. We've seen some more sophisticated requests for information come in, even for our initial examinations, that have resulted in deficiencies around computation. That's why we talked so much in the last panel about how you compute your fees and those types of operations. And I would say, I was talking to somebody about this last night, was been completely different. Is that 80% of those questions used to be about operations, to look for risks and holes in the operations that would pose either systemic risk or risk to the investing public. 80% of your questions had something to do with that. They were operational back office questions. Now it's completely flipped, and 80% of them have something to do with the cyber wrapper that you put around your institution to either surveil for or monitor for those same things in that way. And so lots of institutions are picking third-party providers to help them with compliance. Hopefully they're not all using ChatGPT to draft their procedures. We used to talk about inadequate compliance when you would walk into a firm and the compliance manual was still in the shrink wrap, right? And so for those of you who know what shrink wrap even was for your manual, but the analog, but the modern analog to that is what was discussed in the last panel, is, you know, pulling a policy or procedure and it's still got blanks in it. No one's ever looked at it. So it really hasn't been customized to fit your business. A examination staff can refer deficiencies that it finds for further investigation and or regulatory action. And so those can be resolved anywhere from some informal action and a agreement from the institution to do something different going forward, or depending on what they regard to be the severity of the violation, and actual action being brought against the institution for the violations that they find. And those could be formal, resulting in something that would have to be reported on the CRD or IARD of the individual or the company. That becomes a mark, or something informal that wouldn't necessarily have to be reported. In any instance, it's going to involve some remediation action that you are obligated to take, usually with some period of time. 9 chances out of 10, those deficiencies that we talk about, if you haven't had that scenario come up, simply sit in the books and record of files, and they sit with the regulator until the regulator comes back. And the first thing they want to know is, what did you do about these 9 things? It becomes the easiest layup for the regulator to find deficiencies if you haven't addressed those. The trick will come up, and we'll talk about it here, is that the regulators they'll talk to each other, right? And so you might go, whew, that's great, we're done with that. And then 3 weeks later, FINRA comes, and they may find some deficiencies, and they might find that 70% of the failures to send a notice out to the clients were all in New York. Well, then now the New York Attorney General comes, and with an asterisk, they want to ask those questions. So I always say that an examination process and findings really become a roadmap for responding to the next person that comes along.
Thanks. That's a great segue, Mark, into sort of.
If I could just answer your question specifically, since I happen to have the information. So the New York Attorney General's office has examination authority, but it does not have examination staff. And so that means the SEC does that, right? The SEC has its actual examiners. Now there is an examination staff, but it really kind of just started. When I was the administrator, that meant that there were 79 examiners for New York only. Their budget from then to now went up to from 79 people to around 86 people. This happens, it's not uncommon to this administration, when the budget has been cut and people have retired out and have graduated out. And so that number now is below the 2013 number. But investment advisors have gone up about 30% over that period, right? And so what does that tell you about the ability? Now, they will tell you that there is technology that they are using to make things much more efficient, hopefully not hallucinating violations, right, of individuals that involve. But that's a very important question, not just the empirical number, but what does it mean to the overall numbers? And then what percentage of those then result in enforcement actions, which are uniformly down as they've described.
Great. So jumping off that, I think, an area we should explore maybe right off the bat is, whether and how the state regulators, the different types of regulators, are they complementing, working together with the SEC? Are they picking up in the spaces where the SEC maybe has not shown as much interest in the last year? And what does that look like? What are the areas of focus that the state regulators and the SEC are looking at?
So state regulatory has a pretty predictable habit. In the retreat of federal regulatory oversight, states will usually become more active or more aggressive in the areas where they feel like there's a risk to the marketplace. Now, they don't have all of the surveillance features to do capital markets regulatory, but there's lots of other things where they are operating together. If you're operating in or around the New York regulatory environment, know that the law in New York, the Martin Act, is actually older than the 33 and the 34 Act. And so the jurisdiction of the Attorney General's office in New York is really coextensive with the SEC. And so almost everything that's referred to one is referred to the other. And so that is one of the reasons, as much as they have been criticized, and I've worked there twice, that they are very active in things that seem like national market activity. And so you will see actors, we see actors with an outsized influence and activity in times when there are some regulatory federal retreat by SEC, Justice, et cetera, IRS as well. So I'd say New York, Massachusetts, Illinois, Alabama, for some historical reasons we could talk about offline, California. Some of the same institutions that you think about as having particularly strong or robust consumer laws will factor prominently in this space. You might also see in times that there is less regulatory involvement. You'll also see working groups of other states. There's a North American Securities Administrators Association, to which every state and Canada and Mexico are parties. And so sometimes they will form investigative groups or working groups to look at particular market activity where they don't necessarily have the resources to do it on their own. An office like New York or Massachusetts, California have enough people that anything that's happening in that jurisdiction that is important to the investing public or sometimes to the person upstairs, there are resources for you to do that investigation and still do the other things that meet your mandate. And they also have a disproportionate amount of investment activity in those states. For things that are retirement leaning, and this may be a unique flip scenario, you will very often have a disproportionate number of the customers or clients in Florida because of retirees, right? And so even though they have not necessarily been the most aggressive, they very often become involved just by the sheer number of investors who are involved in whatever the product or service is. And so NASA did have a meeting in the fall when they announced some of their regulatory priorities. And so some of them are the same. I say they're hyphenated issues or that they want to focus on. They found that many market participant services being offered to the investing public now have some hyphen that has AI at the end, has a suffix for crypto at the end to induce people to invest in kind of the rational exuberance. So any of those products, anything that is market linked, that we consider really sophisticated products in a innocuous wrapper, they have participated in an outsized way in those. There's a whole crypto initiative, not to study it like the SEC has done, but to think about enforcement actions. And then there have been unique things that they've announced in this year, including getting retail investors access to things that used to be restricted to the province of sophisticated investors, including private funds, private investments, certain types of REITs. And so that's ongoing. At the same time, actually, that the SEC, with the commissioner, is talking about granting more access to retail investors. And so they're focused on that.
Yeah, I was going to suggest or offer that there's a political bent, a macro political tilt to all this. You see, as the SEC retreats for political or whatever motivation or direction they get from the executive branch, you see the states step in, right? But it's not necessarily on ideological lines, because Mark mentioned Florida might have a certain political bent to it these days, but they are active and out there because of the elderly population there and investor population base there. Also, Texas is more active than one might think, despite being a conservative state and laissez-faire, let the market work kind of political background. They also are increasingly active in getting into the state regulatory space when there has been a sort of a federal retreat that Brian identified and that we've all spoken about, whether it's shutdown related or just instructions from on high on how to approach the market.
It seems like what you're kind of touching on too is maybe a little bit of consumer focus, right? Who are the constituents in those states? Who are the investors that are being protected, right? That's the mandate of most of these state regulators, is investor protection. So, who are they looking out for? And that leads me to another question, which is, have we sort of gone the way? Is there going to be no more focus on, Mark, you said sort of technical violations? I know that's sort of a dirty word, or are those going to be picked up somewhere? Or is it just the substantive, the fraud, the sort of the elder abuse type cases that are going to get the most focus?
Well, it kind of really remains to be seen. It would track the last 20 years easily if federal regulators said that they were going to focus on the Main Street investor. Those tend to be individual frauds, your crypto, your IPO offering type things. They are affecting smaller numbers of people and are less focused on large institutional providers. But sometimes there are things that persist. So, for example, the SEC has announced an investigation into what I would call conflicts in research. Now, that goes back to when I was involved in a research analyst case. I was working under Elliot Spitzer. That was a long time ago, right? So everything old is new again, right? And there are questions about whether or not the institution that is issuing research is exerting any type of undue influence on the research department because it wants investment banking, revenue or business. So there are exceptions to that. Now, I think that investigation started prior to this administration coming in. It's just something that they didn't kill. So very difficult to protect. But I think that you're right. Largely, you have states stepping in to those areas that the federal regulators, certainly the SEC, might be retreating from. And some of those large investigations that caused the New York Attorney General's office to be called the Sheriff of Wall Street happened during the periods when the SEC had retreated from those larger national investigations too. I guess you'd see that would continue, and there are certain states, like Rich mentioned, that have an appetite for taking on some of those larger reviews or investigations of investment advisor activity, even where the SEC may not be participating.
And so, I mean, we've sort of said the SEC has retreated a dozen times here. I don't think that's probably completely fair. And obviously the prior panel talked a lot about compliance and satisfying examination considerations. So, the focuses that we heard about there, fees, cybersecurity, conflicts of interest, are those examination issues translating into enforcement activity by the SEC now? Do we expect that, several months from now? And what is that going to look like?
So I think you've already alluded to the marketing rule, and we talked about it on the last panel. That was the number one topic for the last 3 years. And then this year, it completely disappeared. There are two national organizations that do surveys of investment advisors around the country, and they are providing what their top 3 issues are, either by the amount of time that the chief compliance officer has to spend on them, or the allocation of dollars that are attendant to where their spend is. And so I would say one of the biggest changes is that the focus on complying with the marketing rule seems to have died down. There don't really appear to be many enforcement issues, except for fees. For some reason, right? Fees persist. So I would not go back and tell your staffs that we can, put this at the bottom of the pile, because fee disclosure of fees, fee calculations is certainly of interest to this administration. ESG was a top topic in the past couple of years. That has virtually disappeared, except for the mandate for administrative agencies to look for areas in which there are violations of the executive order against DNI for continuous investing and anything that may represent a fair access law. So that means I have to talk to my clients about whether or not they are invested in any mission-driven funds or participating in that. Now, mostly this has invited some type of splash, and institutions may decide or not decide to back away from those for business considerations. But the one time that it has been challenged in court, actually, the state actor lost an anti-ESG suit. Ironically, the court did it based on a First Amendment Citizens United defense, which is they obviously had a right to invest in what they want to because a corporation can speak as an individual. So as much as that was used in some prior administrations to attack those interests, I've seen basically any ESG, anti-ESG consideration that has gone out the window. But we have seen PE, private equity interest and private equity fund formation still be of interest to both federal and state regulators. I think that's part because the commissioner has announced increasing access for the retail public to those suites of investing services, and so they're going to need to come with some parameters. As recently as this week, in an interview on Fox, Commissioner Atkins talked about the need for that. So I think we're going to see some rulemaking that's going to lay the ground for kind of easing some of those rules and widening the potential market base for private equity investment.
It seems like that was, I think, on the rulemaking agenda that we saw from Commissioner Atkins, Chairman Atkins, earlier in the summer. And it seems like that's maybe, to use another maybe dirty phrase, peeling back from the enforcement by regulation, and maybe we're going to stand up some rules around that first and see how compliance develops, what the examinations reveal, and then whether or not enforcement action is warranted to address those issues. I want to pivot just slightly. Oh, we have a question over here. Sorry.
I have a question about this. So I sit on two fund boards. One's a mutual fund, the other one's an mutual fund. So clearly they want to get more retail investors into these investment opportunities. We all know this industry. There will be some advisors that are going to issue inappropriate products, putting in some rather esoteric instruments. Now we want to start putting these in retirement accounts. Now we want to make this a part of the default option in 401ks too. So any particular, and by definition, these alternatives are much harder to evaluate in terms of prices. They tend to be higher fees as well. So this is kind of rife for all kinds of issues and lawsuits going forward. My question to you is fundamentally, as a board member, what are some of the things I should be really looking out for to protect these investors?
I think that's a great question. I'll let the experts take the first crack at that one.
Yeah, I have a couple of thoughts on things to look out for, type of investments or pitfalls. If it's in a retirement account, you can kind of go either way, but one particularly thorny issue is illiquid investments, such as a private equity or one with a lockup date or a lockup period for certain investments, or like a business development company where it's near impossible to evaluate what it will be. For investors of advanced age, that may not make sense. because you don't know their time horizon. You know, they may say, oh, I won't need the money for 10 years, but then it may not be around for 10 years. And this sort of, even if they have all the forms in place where they'll check the right boxes and informed consent that I don't need this money and it's illiquid, just inherently the proposition of a person at advanced age tying up their money for some unknown amount of time really could just beget a lot of questions on whether that's the right investment for them or whether there were more suitable alternatives for that specific type of investor. So illiquid products with investors of advanced age may not be a fit, full stop. And so I don't know if specific rules or carve-outs or overrides or informed consents will do it, but that is something specifically that the regulators are looking at, because just maybe just on its face, it cannot be a suitable investment or an exercise of fiduciary duty for these.
Disclose it away in the Form ADP.
Yeah, you can disclose it away. You can get informed written consent. Then if they say I didn't understand it, you're back at square one. And for these investors of advanced age, the burden's on the investment advisor to demonstrate knowing, understanding, compliance, and an exercise of the fiduciary duty. So note taking, notes to file, not just a signature, but a specific note evidencing the conversation and evidence showing their informed consent will help. If it's not viewed as a regulator, it's just a null set, not allowed.
Should he increase his insurance, his malpractice insurance?
Oh, yeah, we've done that already.
Or not offer, or not offer the product to this type of investor just as a rule. It's also a possible outcome.
I mean, look, they're issuing now interval funds with like minimums of $2,000 where you don't have to be a QIB. That starts the ball rolling, right?
Yeah.
You get to retail investors' hands who don't know what they're getting in. You can disclose all you want, but I mean, like part of a 401k process, right? The administrator has to be able to educate whoever that employee is, that particular company, over and over again about the specific risks involved with these things.
And so some of these risks may be mitigated because it is a retirement account, whether you care for the liquidity or not. You can't and shouldn't get it into the normal course. So maybe that's a helpful fact for a younger investor. But again, as I go back to the advanced age investor with some of these products, it may be a misfit just altogether, unless and until you can explain how you exercise your fiduciary duty and that investor knew what they were getting into if they chose that way.
Have you seen any precedent for a modern portfolio theory argument? So I'm just going to take crypto, perceived as a very risky asset. The beta is 0.5. So potentially in a down market, having some exposure, and perhaps it's also the private investment also perceived as riskier. Having some exposure in these asset classes could, in the portfolio in its entirety, have better, in this case it would be alpha. So there's different definitions of risk, and there's one in the context of portfolio theory rather than just like a Sharpe ratio, which is a risk-adjusted return. So I don't, because I do care a lot about sort of older generations and not understanding, but there is that sort of thesis around the entire portfolio.
Yeah, well, you're already deploying your thought and exercise of your fiduciary. No, but you're doing the right analysis. So long as this is all laid out, spelled out, and the advisors themselves are educating the end customer, this makes sense. Some would say it's a breach of fiduciary duty not to have 1% in crypto because of the unlimited upside or extreme upside, right? So this is the analysis to undertake, and you're doing it well. So have that in the literature, have that be second nature for the sales force or for the advisors going out there to educate the end customer, and have that all disclosed. There can and will be second guessing if something blows up, but the specific crypto itself, you of course need to do, or whatever digital asset, post the diligence on the front end, assuming you did the diligence on the custody and that it's less risky or just enough risk as a digital asset that you're comfortable with to get your clients in. If you do that diligence up front, you do this kind of holistic analysis on what it means as a percentage of a portfolio, and for the specific customer that it's going to, then you paper it, then you've got as good a chance as any to withstand the scrutiny that we're talking about.
I have clients who like crypto, and we're banging on the door to buy crypto ETFs. And I finally said, fine, but you have to direct me to do it. So they've sent me emails saying, I want you to buy, IBIT or ETHA or whatever. And that's kind of how I deal with covering myself. Because I personally think it's a scam. That's just my opinion as an investor. It's not much of a use case for it other than speculation or money laundering. In the history of private money has never persisted throughout the eons. You can go back to Babylonian times. They always blow up. It might not happen in my lifetime, but I'll make a bet that there will be an event.
Could I just
I try to cover myself by getting specific directions. But other people might like crypto and it's not a solution for them, but I would suggest that's a good one.
Wonderful advice from both of you and from what Rich is saying too. But just on this topic of crypto, if I could offer to all of you, we did a series of coffee chats where we did 2 sessions on digital assets, cryptocurrency, and the blockchain technology. If you go to the Thompson Hine website, you can actually see them at any time. So I would offer those to everybody. And if you can't find them, we'll get them to you. I don't share my buddy's opinion about crypto per se, okay, right? We do a lot of work in the crypto space at Thompson Hine, and we certainly don't recommend any particular cryptocurrency because we have a variety of clients who are involved in a variety of digital assets. But I think what you're saying, the overall thing of being skeptical, it's with any investment. You should be skeptical of Berkshire Hathaway. You should be skeptical of Amazon, all of those investments. And I think that's a good thing to document into, like the last panel was saying about keeping records.
Could you
Just a little worried about crypto.
Could you give some practical advice as to whether his strategy of saying direct me to do it is sufficient so that he is not personally liable?
I think Mark and I both have an opinion on this. I'll just offer very quickly, and that is, I think asking your client to direct you, to say you're uncomfortable recommending it, is always a good strategy. No regulator is going to say, you shouldn't have done it. But Mark, do you have a different opinion? Or
I was going to add, I agree with that. Yeah. I was going to add, you may want to consult your investment advisory agreement to see whether or not how discretion is defined, because there are some kind of compliance structures that are designed as you having 100% unfettered discretion. Some go on to say that your fiduciary duty includes the right to refuse to invest in something that you have determined is not in the best interest of your clients. And so, not that you couldn't then get a release from them, but I'd want to know what your advisory agreement says. For some, you are acting at their discretion, whether or not you think it's in the best interest of the client or not, and then you know what that is. For those that have automated procedures, you want to know what the triggers are for those investments or not. Say that you are running a company that has a platform that has some discretion, and then maybe you have some self-directed in there as well. Be thoughtful about what your advisory agreements say on that point. I think in this environment, it would be very difficult for a regulator to come in and be too critical about that. I will add 2 caveats because every lawyer does that, right? The SEC has said that there are some conflicts that cannot be disclosed away. They just can't be by including them in your disclosures. They're just so inherently risky or bad for the client that there is some obligation for the institution to not do them. Now, I've seen people stand up and challenge the SEC in the face of those, and they'd say, well, maybe that part of the business is not for you. Maybe you're a prudential and conservative investor, and you're not going to play in those parts of the market. And you certainly don't have an obligation to do it if it's not in the best of your client. And so maybe, a particular clients in a particular asset are not for you. But they've never put any other meat on the bones than that. I mean, I think it's a catch-all statement to say that there are some things for which disclosure is inadequate, doesn't matter what it is. They obviously will not provide an exhaustive list of what those things are. They'll just say, you know, if you see it.
That's an interesting comment because I have my CFA. And if you look at their code of ethics, if a client tells you that they want to do something, you're pretty much obligated to do it, right? Within some sort of reason, I guess. But
What I guess I'm saying is I have seen at tension investment advisory agreements that say something different than that.
Yep.
And so you'd either want to square that or make reference to that. And just no one understands what your agreement says are the rules of the road.
I was going to say, my experience in that role has been that was not enough to have them just direct you, but to also amend the agreement and have the agreement updated in front of the client. If you know, to protect yourself, not necessarily from the regulator though, from when it goes bad, you know, the outside lawyers that are looking to profit.
A lot of agreements were updated back in like the mid 2010s, and the reason why they were
crypto in them.
Well, no,
That's what we're thinking.
No, actually not crypto, but to what Mark is saying, which is really important, it wasn't so much for crypto purposes, but it was for elder abuse. It's like a lot of investment advisors were having to deal with, you know, they'd get this strange phone call from John Smith, you know, and they had been dealing with Jane Doe, who was a retired teacher in her 80s, you know, for years and years and years. And all of a sudden this like 20-something-year-old kid, John Smith, was calling up and saying, oh, direct $10,000 to the local Rolls-Royce place. And a lot of investment advisory agreements were then updated to have this type of protection, to allow for this type of protection that Mark is saying. And it just, I think it flows very nicely into the digital asset space as well, too.
Well, Mark, are we still in the era of gatekeeper liability, or is that, your experience, is that gone? There's no longer gatekeeper liability?
So there has been
he would consider a gatekeeper.
Yes. Yeah. So there's been a bit of a retreat from the very austere gatekeeper liability that, you know, around 2016 was really top of mind for anybody who served as a fiduciary, chief compliance officer, where, you know, they were very rightly concerned about taking the bullet for whatever the institution has done. That doesn't necessarily inoculate one against a view from a regulator. Everybody at this table has dealt with regulators who have been presented with a very robust disclosure to investors. Not only that, it's in the disclosure, but sign here, sign here, sign here. Oh no, we're never going to create a whole separate thing. So you know that everybody knows it's been reviewed and signed by, and then they still said, no, this is per se unsuitable, right? And so you really have to talk about these things on a risk continuum, and you can only use the tools that are available to us. I think that this particular administration, if I'm guessing, but what is happening when the chairman was asked this question this week, all he really said was that we want broker-dealers, investment advisors, to 401ks to exercise their fiduciary duty to look out for these retail investors.
Good luck. Good luck with that.
And so, which is an answer, not answer, unless it is coupled by any easing, any rulemaking that is going to provide any more cover. Sounds like for now, he's putting the onus on the fiduciary, and so you just have to be more thoughtful and document your rationale for the things that you are doing. But you know, if I had a crystal ball, and I'm guessing here, and I don't have to, you know, provide the disclaimers anymore, you know, the thoughts and opinions are my own and do not necessarily represent. I think that this is going to be coupled by some rulemaking. There'll be a pretty significant push. For as much as lots in the industry were complaining that there was an avalanche of rulemaking that was coming up in the last administration, and there was, you could hardly keep up. I think that this will be one area in which there will be some contours around rulemaking, mostly because it will accommodate this push to open access to retail investors of these other products. Because for, you know, almost my entire career, there just were different rules for retirement accounts.
Yeah.
Right. In order to protect, or if there is an alt component, it's a very small sliver, so that the risk to the overall portfolio, right, is minimal, and you minimize the risk in that way. I don't know if they're just take the lid off of that, or if they're going to provide special exemptions for the person who would previously take the bullet. And so I guess we'll see.
Yeah, I was going to suggest, especially as the retirement accounts, there's maybe an administrative-driven push or an industry-driven push for that to be the new frontier of new capital into these products. Rulemaking will help because of what could be or should be the skittishness of any fiduciary of countenancing that, if not recommending that themselves. So maybe rulemaking will give the cover that you all or the investment advisor may need in order to follow through with this. Just because it's available doesn't mean it's a good idea. But I have a feeling that from the top down, there's going to be something that fills that gap from what's available to what's actually going to be happening or what's recommended.
So, Mary had a question over here.
Does it help at all? I've only done this twice, but does it help at all if you have the client sign the investment parameter page? Like I literally I come from the institutional world, so I document the investment parameters and I date them. And for certain clients that I think might be skitsy, at some kind of risk, I have them sign them. Does that offer me any protection, or is that just a ruse?
It doesn't hurt.
Yeah, it does offer you some protection. If it's not documented, it didn't happen. And if it's not acknowledged or sent or signed by the investor, it didn't happen either. So you going through that process is an attestation by you and the customer that this conversation happened and it went like this and the customer wants to proceed. So it does help.
This is actually just the guidelines, right? But you're right. I also have that in the notes, but then on my actual guidelines, which is what drives everything I do for every client, I have an investment parameter page, and only for a couple, like including the one that came to me when she was 89, I made her sign it because I want to take on added risk.
It helps, but think about who's signing it. An 89-year-old who may not have the knowledge or proficiency or even the faculties for that to mean anything. So it's a give and take. Having it helps. Whether it stands up and has standalone value really depends on the facts and circumstances and whatever backup you have and whatever story that 89-year-old's lawyer is telling that differs from what's on the page.
I'll say it opposite. I don't like my chances if we don't have that.
Yeah.
But I like
yeah.
But I like having it. It gives me something.
Because that means it happened.
Right.
If it's not written down, it didn't happen.
Right. So we've kind of this has been a very robust discussion. We've touched now on some client interaction points. So Rich, what are you seeing in private litigation, customer-client disputes? What are the issues there? And maybe we'll do this in sort of a rapid fire fashion. We only have about 10 minutes left.
Sure. The scoping out of the engagement is really important. What is the investment advisor to do? What are the services he or she or it are providing? One issue that we've run up against, and maybe you all have dealt with this, is the tax ramifications of any piece of investment advice. Oftentimes we're not tax professionals. Go seek your tax professional's advice. Go to your CPA. We are not your CPA. But if your conversation touches on these issues, you're all of a sudden wading into those matters. So if you're going to make a representation that something is tax advantage, tax preferred, or even helping them exercise shares and pay down what's owed for restricted stock units or something to help them navigate holdings in their own company into the broader investment space. Anytime you're doing anything like that that touches on a taxable issue, make sure your client knows that you're not providing tax advice, because what we've seen is anytime there's fallout, instead of going to their accountant who may not have the deepest pockets, they're going to go to the investment advisor doing anything that had tax ramifications. And if you don't disclaim it well enough or specific enough, that's going to blow back on the investment advisor. So that's something I've seen litigated a couple of times, 2 or 3 times now, despite the language of we're not your accountant. As soon as you wade into that issue without having the accountant on the phone, it may be a matter of the investment advisor's liability, or at least a claim that it is. So that's something I've seen. And scoping out your services, what's not covered, and making it crystal clear is a helpful exercise.
Are you recommending that be done in writing?
Yes, in writing and in practice. Get them, the customer, to say what the accountant said about this transaction and note that. So now all of a sudden you have a learned professional discharging their duties, which are different from the advisor's duties, which are probably, if your agreements look like some others, disclaiming any provision of those tax services.
Can you say something like, this is what I believe, but you need to verify this with your tax account?
If you believe it, you better have a basis for believing it.
You have a basis,
And then if you are wrong,
but you need to verify before relying on this information with your tax advisor.
yes, and I would be really clear that you won't proceed until and unless they went to their tax advisor to double check or, for the first instance, do the
A
analysis.
lot of times it's off advice. It's, I'm doing this, what's the tax effect? And you say, well, I think it's this, but really you need to get very specific and go to your tax advisor and verify this. Because I am not a tax expert.
This is waiting in the exact fact. I've dealt with 2 of these issues in the last 2 years. This is very similar fact patterns, and the advisor ended up being accused of giving bad advice. So I know this is a trap for the unwary, but that's why I wouldn't proceed unless and until you have a notation that they checked with their tax advisor, and now we're proceeding. It also takes a certain kind of client to push this theory, but if things do go wrong and the tax advice or your belief turns out to be wrong, they may look for recompense from somebody, either you or the accountant, and if it's you, then it's your turn.
And if they don't have an accountant?
Then it's even more based on the advice that you gave, subject to them seeking advice from ChatGPT.
So the first iteration of this was an inclusion, so all the legal mishmash gets in, right? Was a disclosure that you should seek independent, legal, accountant, tax advice on the suitability of this investment, or advisability of this investment for you, right? Then people were sued off of that, right? And so then attorneys added a second section that says that your advisor may detrimentally rely on your representation that you have sought all of this advice necessary to make an informed decision about the fitness for this investment for you. And then someone sued off of that, right? And so this next step, again, is not an identification, a bulletproof against liability, but is another thing that is very helpful to people who have to answer these questions when someone, despite having signed all those things, is still intent on litigating. We always say we can't stop somebody from suing you, but we can advise you on the best tools that you can utilize if someone does.
Very good. So very quickly, I'll kick it to you, Mark. Anything in the private litigation sphere that's being driven by cybersecurity issues, data breaches, is that a mushroom event that's happening, or is it still just slowly growing?
It is, and we talked about how this is a growing area, and it's probably for good reason that we keep this at the front. Cyber is a issue right now that it's administration agnostic. Everybody's thinking about it, and the risks attendant to those are not the province of I think regulatory ebbs and flows. So cyber is included as a hot topic in almost 50% of all investment advisors who were recently surveyed. And then you add in another 10% where they talk about vendor due diligence, which is almost 100% cyber, right? So I would say that these issues are probably almost 50% of what folks that are doing what you do are thinking about today. I guess if there's any silver lining, it's that the Supreme Court, since the TransUnion decision in Ramirez, has said that you have to prove actual harm if one is claiming that there's been a breach. This has been holding for now, but it's also created a rush to the courthouse of anyone who has actual harm. So as recently as last month, the Fourth Circuit Court of Appeals issued a decision that basically dismissed all of the claims. So there's been a years-long issue of people filing as John Doe, as being a victim where there's been some intrusion. Mm-hmm. The Fourth Circuit said you have to have actual harm. You have to prove some actual harm. And so that held up. But there were two people who could demonstrate that their personally identifiable information was existing on the dark web, and that's the place it could have come from, ostensibly. And so the dismissal was largely successful, except for those two people. So this is something that we monitor, and it crosses lots of sectors. It just doesn't apply to financial services. It's just that these last two cases were financial services and those that are selling insurance products. As recently as last week, there was a Florida district that also reiterated that you must demonstrate a concrete and particularized injury in order to have Article 3 standing in federal court. And so they threw it out. But this means a compliance, the note I wanted to make is it means that compliance must have robust cyber policy and procedures. And it's crucial that you have cyber incident response methods that can demonstrate whether the intrusion resulted in any harm. Otherwise, you're setting yourself up. You're not giving your counsel any ability to push back and defend.
Very good. So we'll close this discussion by sort of looking ahead as best we can. The old crystal ball, as Mark likes to say. My first question is for you, Mark. Do you anticipate AI becoming more prevalent of an issue in investment advice, marketing, and on the flip side, how it's used either in compliance for surveillance purposes, within firms, or by the regulators to identify anomalies and identify deficiencies that they're then going to pursue in enforcement?
Yes and yes. If I was sitting in that seat still, it'd probably be the thing that I was thinking most about. It's all the ways that my institution was using artificial intelligence. Anybody in financial services knows that financial services has been using what we're calling now artificial intelligence for many years in various different ways. But now everybody has access to it. So I would be thinking throughout the institution about all the ways that it is being used. Our portfolio managers using it to write things that are describing products and services in ways that they shouldn't. Are we using it to come up with policies when we know, though we don't know why, that AI hallucinates, right? And so I'd have to have a cyber policy around that. So that's internally. Regulators actually use it too, right? Mostly they call them advanced surveillance features. But we know that nothing goes out from the regulator after they get the results back, and they still have a person that actually checks those things before they go out in any type of enforcement inquiry. So you're going to have to know and understand how it's being used in your institution. And as much as I'm afraid of all the ways that it hallucinates, I think adoption is necessary.
So I headline again, yes and yes. Rich, one piece of advice for the RIAs the next 12 months to either avoid getting in the crosshairs or to navigate a sticky situation that is likely to involve potential downside enforcement risk?
Yeah, I think we talked about it as the advisor space and as customers become more interested in alternatives, digital assets, and some of these private placement or private assets. Documentation of the product due diligence on the front end, especially with respect to custody. If it's a digital asset, understanding the technology at play and documenting it at the company level, at the firm-wide level, and then at the individual RIA level, that everyone understands the technology underlying the digital asset, whatever AI tool is being used internally, and able to explain that in layman's terms and also document that internally. I think that's going to be a prerequisite if anyone is going to be recommending or putting any customers into these products. That's at the base level. And also, again, going back to the marketing rule and all that, if you're using AI and you're touting your use of AI and your processes and procedures, make sure you substantiate it, make sure it's documented internally, what's being done, what the parameters are, and the coaching around it, and making sure that what you say you're doing actually matches what you are doing and what is documented that you're doing. And again, back to these alts and these other investments, documenting this kind of decision tree matrix and the thought process of making it a part of a portfolio, model portfolio, and then taking that model portfolio and applying it to the individual customer at the end and documenting that and the conversation you had or should have had, or the disclosures will be necessary if and when there's a blow up, if and when there's a downturn. If you heard me say it twice, you heard me say it 100 times. If you didn't document it, it didn't happen. So having this at a firm level and in your CRM at a customer level, with a date and a time and a who, what, where, and when was involved with this is necessary if you're going to hand it off to defense counsel in a God forbid scenario.
So there's a lot of platforms now that will integrate with CRMs that will transcribe, record, whatever conversations, right? Are those acceptable in terms of being able to document conversations? Use the handwritten notes or typed notes?
And those are better. I mean, as a lawyer, that would make me cringe, right? Having any conversation recorded, me as the lawyer. But you all, better yet, because now you can hear it if it's recorded or transcribed. You could have the words of the customer written down and not just their initials or their signatures.
How would you feel if it was summarized by AI? So it wasn't recorded, so you're not recording someone illegally, depending upon state law. It's not transcribed because it wasn't recorded, but it's summarized.
Notes help. Having an explanation as to why this process or this tool works for this, and having that note and file and that someone investigated whether this is a good tool for this purpose would help. But more information, more record keeping, the better. But make sure you keep it. Don't just throw out the bad conversations and keep the good ones. Keep them all.
Save them all.
Yeah, save them all. The good, bad, or the ugly. But I'm for it because more documents in the file is demonstration that you're performing your fiduciary duty. And again, better yet, informed consent or informed understanding by the customer is really helpful on the back end when you hand it off to your lawyers.
Perfect.
Yeah, go ahead. I'm just adding, if you are using those technologies to do your note taking and there is counsel on the phone, make sure you ask them, this is being recorded.
Yes.
And it's okay if we use this, for this meeting with this device, and give them the opportunity to weigh in. Because if it's advice, then it's advice, and we could talk about the protections and if the reasons that it might be violating. You want to make sure that counsel isn't inadvertently blowing that just because he doesn't know.
Yeah. And I actually have a different take on the note taking because there's such a thing in our society now about AI hallucinating a great deal. If all of a sudden the notes come back as being very positive for one side or the other, that's going to be called into question. On that note, I want to thank Brian and Rich and Mark again for doing this yeoman's job. And please, 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 if you have any questions, reach out. Mark's comment about people, suing, and Rich, talking about it never happened and everything reminds me of the story of Alex Rodriguez's divorce lawyer. He's coming out with a new book too right now. And he talks about his divorce and everything. And there was a great story when his wife was divorcing him. She had all these salacious allegations, put them in a complaint, and it was filed. And Alex Rodriguez had one of the best divorce lawyers in Florida. And the press caught him on the courthouse steps one time, like this very wise, like right out of central casting lawyer. And they're screaming, asking questions. What does Alex say about this? What does he say about this? What does he say about that? And some of you probably remember some of the allegations. And he waited for a pause in the screaming from the press. And he just looked at the press and he said, in a very low tone, he goes, anybody can pay a filing fee, and just walked away. He stunned the entire press. And that's exactly what will happen. Sadly, no matter how much you document, no matter how much you do, it may not stop the plaintiff's lawyer. Sorry to say that, everybody. Now, we're going to move into our networking event. We want everybody to get an opportunity to meet each other and everything. We're going to reconvene at 2:30 for our last session. Okay? Thank you so much for all being here. We're going to come with our last panel presentation today. We have a nice little catchy title, Deal Making in the Registered Investment Advisor Space. And joining me today are my two wonderful colleagues, Shelby Harvey, who, there she is right up there. Poor Shelby has experienced firsthand the air traffic control situation, has had, what was it, half a dozen flights canceled, Shelby? At least, yeah. We can't, can you hear us? Oops. Uh-oh.
Can you hear me? Is
There
that
you
better?
go. Oh, you got you.
Okay, there you go. Yep, that sounds right. Ernie spent a good bit of the day on Saturday at the airport trying to figure out how to get there and ultimately wasn't able to make it work. So here we are.
Here we are. So at least, like Danielle, we were adjusted. And I asked her to join us because, she was in house and she'll be able to comment on what Shelby and I have to say. It's interesting. When we were putting together this program, we wanted to make sure that we really spent a good fair amount of time talking about this. As I said to you at the very beginning, at the opening, one of the things that we're seeing now, especially in our space, the types of spaces where you are operating as registered investment advisors, we have found people are beginning to think, what should I do? They certainly don't want to leave their jobs, and no one here is suggesting that they should. But what happens? What happens if A, B, and C happens? And great, perfect. We just got a sound check. Lee says everything sounds great. So we're really happy that we can talk about this. But just like the other two panels were interactive and they did such an amazing job, all the panelists and everything, we want this to be just as interactive because we think that this is really going to be the real personal issues that you're dealing with on a daily basis and that you're thinking about in terms of your future planning and everything. Now, I do want to say one thing. No one is obligated to say anything, but by all means, please say something. And again, like I said at the very beginning of our sessions here today, you can certainly change the names to protect the innocent. But we are here today to talk about these particular issues. So I want to mention one of the dominating things that's occurring in this space is this idea of merger, aggregation, joint venture, shifting to different platforms and things like this. And there are a plethora of things to do. And so I want to turn to Shelby to talk to us a little bit about, to begin our discussion here today, about the market landscape and what we're seeing in the types of quote unquote deals that are happening in this particular space. Shelby, I apologize. We apologize for looking at our back.
Yeah, no problem. So Ernie, do you mean that the various kind of flavors these transactions can take the shape of?
Yep.
Okay, so I'll go to this slide here. So we see these transactions take on a number of flavors and shapes. Primarily, they're either an asset or an equity transaction. An asset transaction, I like to describe this as a kind of primary M&A lawyer. An asset deal would be where a buyer came in and bought all the stuff outside the inside of the house. The equity deal would be the buyer bought the house. And so there are various, reasons for why one may be favored over another. In this space, it's either tax driven. Sometimes an asset deal is more favorable to a buyer because they can cherry pick liabilities and kind of reduce their legacy risk there. Another reason for why an asset deal would be disfavored in a traditional M&A context would be because sort of the retitling of assets and assignment of contracts can become kind of cumbersome. But as our colleagues talked about earlier in the first presentation, the client consent process is going to be relatively similar regardless of whether it's an asset purchase or an equity purchase. So that's sort of a less significant reason for why you choose one versus another. So these deals can be 100% purchase the assets or the equity, or it could be something less than that, where a buyer would come in and purchase a minority investment, or the flip of it, where the buyer would buy the entire business, but the seller could retain a certain percentage or roll over equity into the buyer's existing structure. And these deals kind of different from structure. There are some key features these deals often present with. Most often they've got some element of upfront purchase price, a cash upfront purchase price, and then some deferred consideration either through a seller note or an earnout. And then another kind of key pattern we're seeing in the market are the platform acquisitions with the following add-on and tuck-in transactions that happen thereafter. So we see these big PE-backed buyers, buying a large RIA and then use that large RIA as the platform for adding on smaller advisors, whether that's to achieve like a new geographic market or a new niche, like for example, professional sports athletes or something like that. And then tuck-ins are more like, you know, a buyer's looking for certain technology or some sort of add-in to the existing platform that kind of smaller acquisition would bring.
And I think what Shelby's pointing out, and the reason why I wanted to begin that sort of way, is to give you the panoply of how you should consider this. We're not here recommending for even a moment one over the other. You know, this is really driven by you as the RIA, as the professional, as to how you want to continue to work, or whether you want to work at all. You know, whether you just want to say, okay, you want to monetize your assets and everything. And so you were in-house.
I was going to say I was actually in-house during a merger or an acquisition. So I was at a wealth management firm, and you know they've been in the business for 20 plus years, and I think they wanted to slow down and sort of exit as well. And so what they did was there was a purchase. So Hightower, it's public information, publicly disclosed, had purchased this wealth management firm. And what Hightower's business model is that they purchase a bunch of investment firms and they let them run individually as they've been running. However, they provide all the back office support. So it's a centralized back office that has acquired, again, these smaller investment management firms that are then able to continue to run on their own.
Yeah, it's it's funny. The more things change, the more they stay the same. When I first started practicing, we used to call them independents. You know, independent broker dealers, independent investment advisors, who then would do the back office compliance. But the business model has slightly changed, and that raises issues. No matter how you decide or what you decide. One of the things, as you heard from some of our panelists before, especially our first panel, when they were talking about the regulatory and compliance issues, I always like to tell clients when they get in this space, because I am the dark green club, I will always tell people the worst case scenario to prepare them for it, is remember, whether it be the SEC or the state, they could say no. And so that means you have to prepare for the process, okay? It's not just, and I know this is a lot throwing at everybody right now, it's not just finding a way forward, okay? It's how are the regulators going to respond, okay? Now, one of the things that if it's a sale, of course, the regulators will respond accordingly and will make a decision about whether they think that transaction is appropriate. Primarily focusing in on what we talked about on our first panel about whether the clients have agreed to this quote unquote assignment in some way. Okay. But there's more to that. There's more to that. For example, one of the things that regulators will look at is they'll look at both the buyer and the seller, whether there's going to be an appropriate transition, whether that is going to be in place, whether, customers are going to get lost in the shuffle. They're going to be very concerned about that. And I have seen questions coming from various states and the SEC staff on this particular issue, okay? Because it's not just, looking at it from a percentage of like dollars and cents, okay? So they're going to be looking at it from that perspective. And they're also going to be looking upon the transition, whether it's going to be seamless or not, or as best seamless as possible. And I will tell you, I've had questions come up even when the custodian doesn't change. Shockingly, it's like I've had that before. One of the things that will come up is, when was the last time you updated your customer account agreement? You'll have things like that. There'll be requirements about that will go into it that you wouldn't have expected. And then, of course, the mechanics that go into it, the changes to the Form ADV, okay? I have a cousin who's retired from the IRS. He graduated college, got his CPA, went to work for the IRS, was a supervisor, put in his time there. And I always joke with him, that the IRS could care less about, raising money for the U.S. government. The only thing that they care about is the proper form being filed. And he never admits it, never denies it, just smiles when I say it, okay? And that's exactly the situation in our area as well, too. The regulators are looking to make sure that the proper forms have been filed. the proper disclosures have been made. I know there was a question earlier today about accuracy and everything, and a discussion about that. They are looking for those to be accurate. They're looking for them to make sure that what is being disclosed to the public, both in the part one, the part two, the business continuity plans, the disclosures that go, the BCPs, excuse me, that go to customers. They want that to be there. They want that to be there. And like when you were in your turmoil, transition, what did you see?
So I was going to say with us, I think, transition was really important, especially because it was a high touch wealth management firm. And so we kept a lot of the personnel. That was, I think, what's really important, and had a lot of the personnel, although they became employees of the new advisor, they were still around, and that was part of the succession plan, and that was also part of the acquisition to keep this sort of transition as smooth as possible. So,
now we want to transition. Now we're going to oh yes, David.
Just a question. So you mentioned that there was an aggregation of smaller independents. Do they keep the names the same to be less disruptive to the clients?
It's interesting. It's a great question. Yes, they did. So long story short, but so it's all under, for example, Hightower, which is the investment advisor firm. That's the registered firm with the SEC. However, they've each individually kept their boutique names.
Now we want to transition to a slightly different topic, because it's something we've been seeing, and Shelby is going to talk about and discuss with us the private equity buyers that we're seeing, what the issues that pop up with that, because that is a different way of looking at how this business has operated in the past, primarily because private equity firms have a lot of the cash in our economy right now, and they're looking to spend. Shelby?
Yeah, so there are a number of reasons why a seller may or may not want to take on PE money. And as I said before, it can come in 100% or just in part. And so the considerations depend on whether or not it's an all or nothing. But so some pros, of course, would be PE money gets you access to better infrastructure, back office services, potentially equity incentives for your key talent that you may not be able to provide as an independent. And as much as this is all sort of succession planning focused, a lot of smaller RIAs are looking to grow themselves. And so PE money gives them the ability to take that money and start acquiring its growth capital for them. But, depending on the personality of the particular advisor, it may not be a good idea, especially if the PE is going to exercise a lot of control over the governance after closing. There's performance pressure and potentially, friction issues between that advisor and this new kind of regime over what it had been their, business that they were able to freely run. So it's really just driven based on what the advisor's objectives are in the long term and what kind of control they're willing to tolerate from a PE who comes in.
Yeah, and look, Shelby hits on a great point, and that is this is a different way of doing business than what you normally would be doing. Now, again, we're not recommending any approach one way or another. It's all personal. And candidly, we've had some clients who we've discussed these issues with who are all gung-ho to, do something with their practice, merge or what have you, who decided after kicking the tires a little bit, no, I'm going to stay the way I am right now. I'm not going to do anything new. I'm not going to do anything, sort of radical. I'm not going to do anything radical, which is completely fine too. There's nothing wrong with that. But part of what we want to make sure you're aware of too is if you do decide to go down that route in terms of merging, aggregating, joint venture, whatever that may be, acquiring even, one of the things that you may want to consider is some of the regulatory and compliance considerations. We've already talked a little bit about the successor registration and the Form ADVs. One of the things that Zahir was talking about with her old firm, about how they were continuing to operate under their old sort of brand name, but under the Hightower investment advisor. What happens to that old investment advisor? What happens to it? I always like to tell people, I always ask that question, and I truly agree that when I ask that question, okay, I sound like a used car salesman. because as many people who are thinking about this in this sort of category to like sort of do something else to a different way, there are other people who are looking to purchase investment advisors. And so I always say that it's like, don't think for a moment that, you know, that you're going to have to necessarily close it, you know, file a Form ADVW. You know, you can in fact sell it. Someone may want to buy it. And, you know, that's a value, that's an asset to also consider as well, too. And
I think these aggregators are definitely becoming more and more common where they're providing back office services, especially for folks who want to wind down. And so, you know, they can just manage assets and manage their clients while slowly sort of transitioning off.
Exactly. I thought if someone, by the way, if someone has a question,
I actually do.
Sure, go ahead.
If you were looking at an aggregator, what questions would you ask if you were a seller?
It's the same questions I would ask for any new situation. Okay. When you're talking about with an aggregator, you're looking at a number of different things. You're looking at control, you're looking at finances, and you're looking at end result. Okay. Meaning that in control and end results are sort of like, you know, two sides, different sides of the same coin. But the financial aspect to it goes both ways as well, too. For example, are you going to an aggregator that has the capital to support you? Okay. That is not some, and we have seen this. There are some aggregators out there who are better than others. You know, let's just be honest about it. And that part of that financing aspect to it is, what are they going to pay you? You know, what are they going to pay you? What is your compensation going to be? You know, I joke, I teach at a couple of local law schools, and I teach in this area, securities. And I always joke with them, you know, I am a capitalist, you know, and like, I understand that we're out here to make money. And, you know, I put no shame on anybody who does. And, you know, I think I tell my clients all the time, you have every right. You've built this business. You've built this opportunity now, and you should cash in on it if that's what you want. If that's what you want. And, you know, we're trying really hard not to push one thing over the other, you know, so I think that's important to keep in mind. And then finally, what's the end result going to be? And this goes back to asking yourself the question, what do you want to do? Do you want to continue to be business as usual? And so here talked about like the situation where in a situation like that with an aggregator, you could have business as usual. But I know others where it is not business as usual. You have to conform. They're paying you. You have to conform to the way they want to do the business. So it's really, those are the questions you want to ask. But more importantly, you have to be comfortable in knowing what you want from the end result. So
yeah, I was going to say exactly that. I think it just depends on what the individuals who are running the business, own the business, really want at the end of the day. You know, what I've seen it with folks as they're getting older, wanting to slow down, but still loving what they do. And so they're just trying to offload all of this back office, you know, nonsense in their minds,
yes.
Such as compliance and accounting, you know, all back office accounting. But they still want to, you know, stay in the game, you know, and as long as they can. And so I think that, you know, joining, you know, selling to an aggregator really allows folks to do that.
Yep, question.
So I'm asking this for a friend.
Yes.
I'm kidding. No. You see a lot of these deals. As a practical matter, how many suitors you need to talk with before you get comfortable?
I'm going to start with Shelby. Shelby, what's your answer to that? And then Sayir and I will also jump in too.
Yeah, so I mean, I hear from clients that they get many phone calls from folks interested in buying their business. And so we say, like, keep operating your business as you are. You're likely to attract the right buyer for you. I can't give a set number, but I think, you know, once you've had a fair number of outreach in your direction, you've got the opportunity to kind of analyze what the terms may be as between each potential option and can kind of get an idea of which direction you want to go. I don't think there's a set 5, or I couldn't give it a number, but I do think there is value in evaluating various options and try to figure out which one might be most aligned for you and your objectives. Ernie, Sahar, do you have other thoughts on that?
No, I just have an interesting story. So again, I was, in-house at Bel Air Investment Advisor, wealth management firm in Los Angeles. And it was started by 3 guys from Goldman Sachs who decided to go into the private wealth, start their own business. So they did, called it Bel Air Investment Advisors. State Street came around, bought it, tried to run it for about a year or 2, couldn't, sold it back on pennies to the same original sellers. Kept doing their thing, monopolizing a lot of the, Hollywood money. And then when I was there, it was just purchased by Fiera, which is a Canadian public bank. They couldn't run it. They tried for a couple years. They sold it back to the same folks who had purchased it, who had sold it initially, same 3 guys. And now it's with Hightower, and I think those 3 gentlemen are enjoying not having to deal with all the back office stuff, but they've made a good, pretty dime on their business.
Yeah.
So, like 3 times, same business.
And I think the learning lesson there is that these businesses are so focused on the personnel and their relationships with the client. And so you're going to want to find a buyer that's going to allow you to keep your client focused mentality, and that will, give you the best long-term result. It seems like the folks in Sahar's story didn't quite, follow that motto. But if you can find a buyer who's going to keep your clients at the forefront, that's a win.
And I think you have a lot of negotiating power, really, as a seller.
Yeah. So. And I will add this too. I do get phone calls from clients sometimes where they're saying, nobody's interested in my business. And then we start to talk. And then I go, but you told me 2 weeks ago that so-and-so called you. Oh, yeah, that's right. And then didn't someone else call you too? Oh, yeah, they called too, And and by the time the conversation, a 10-minute conversation is over, we've talked about a half a dozen suitors have called this particular client. And I chuckle because what I say to the client is, what that tells me is, it's not that there's no interest in your business. You don't have an interest in who's coming to you, which is fine. You don't have to, you're not going to find your true love, right away. You know what I'm saying? It may take some time, that's the way it is. It's just like, I think that's sort of like what you're looking at. I shouldn't put love in the category in this situation, but I think you get my point on that. Now, one thing I do want to mention when we're going through these compliance issues and getting ready and like talking about this is it's a wonderful opportunity for me to pontificate on why and how and the wherefore as to how you should get your documents in play. Okay. That is your compliance manuals, your policies, your P&Ls, okay? Making sure your audits are all up to snuff, okay? Making sure that all your filings, your Form ADVs, both on the advisor level and the advisor, the individual advisors are all appropriate. Making sure that your businesses are all aligned with investment advisory work. Making sure you've been in contact with your clients and that you just haven't forgotten about them. I know everybody here, that's perfect for everybody. I know it is, okay? But a lot of times that's not perfect. I represented people, it's a one-person shop. I remember this one person I represented, he actually is kind of interesting. His office was in the town next to mine. And he had about $10 million under management. This was about 20 years ago. $10 million under management for the last 40 years. Okay. But it generated a wonderful income for him. And we started to talk. And I said to him, I go, so how is the investment advisor structured? He goes, what are you talking about? I'm the investment advisor. It was a DBA. There was no corporate structure around it, no LLC, no holding company, nothing like that. And, I go, and you've never been sued? No, why would I get sued? Just like, these are some of the questions, have you ever, and then just another story, and then we'll move on to another topic. I once represented an investment advisor who was actually an investment advisor in the private equity space, okay? And I formed his investment advisor. Wonderful guy. But we were going through the process, and for those who've gone through the investment advisor process, I think it's not fun. The application process, it's like Sarah and I just went through it, so we know it's a proctology examination. Let's be honest about it, okay? And I'll never forget going through this. And then we were preparing for that. I think someone said it earlier today, that 6-month exam that comes after you become an investment advisor. And in preparation for that, I told him, I go, make sure you have A, B, and C. And he was fine with most of it. And then I go, you also need to have a customer complaint file. And he lost it on me. He just went off on me. He said, Ernie, have you lost your mind? What are you talking about? Okay. What are you talking about? He goes, you know, I have no retail customers. You know, I'm an investment manager for private equity and hedge funds. Why are you asking such stupid questions? And I go, can you do me a favor? Okay. Can you just please have the file ready? He goes, you know, I'm beginning to question not only your intelligence, Ernie, but your sanity. And by the way, that's a direct quote from my client. Okay. Lo and behold, a couple of months later, the state, it was the Commonwealth of Pennsylvania came in. They came in and they did an examination. Okay. First thing they asked him for, let's see your customer complaint file. They come in, it was like a half-a-day examination. It wasn't a big deal. Okay. He immediately, he says, you're the first person I'm calling. You're still a blank, but you were right. That was the first thing they asked you for. Some of the things that we share with you and prepare you for, it's only because of what we expect will happen, what we expect will happen. Sorry for the long war story on that, but that's something that you should be prepared for, you know, and having all of that ready and having all of that prepared. Now, we're going to shift a little bit into risk and diligence. And Shelby, can you tell us a little bit about, like, you know, the focus and what we should be looking at?
Yeah, so from the buyer's perspective, the financial diligence is going to be the most important. A buyer's going to get a fulsome quality of earnings report. They're going to assess client retention dynamics, your fee schedules, your client concentration. Where are you getting clients from? What's your pipeline? How dependent are you on certain key people? Those sort of things that, you know, what's the business theory of the deal is going to be important. And how likely is there going to be client attrition after closing? Separate from the financial diligence assessment, there'll be a more general risk assessment. For an RIA business is different than, you know, your run-of-the-mill M&A transaction because it's pretty asset light. There aren't forklifts and employee injuries and many things, categories of things you don't need to look into, but there are a number of things that you do. Of course, the compliance elements that we've talked about a lot today are key, but then other things that can come up in any business, employee litigation, real estate leases, those sorts of things will be an element of diligence. And so to the extent a buyer identifies specific risks like active litigation or disputes with a client or something like that, the buyer will affirmatively seek indemnification protection for those known issues in a purchase agreement. So we can talk more about how the indemnification package works later. But I think financial diligence is the most important, and it's going to be what a buyer focuses on. They want to make sure the cash machine is going to continue after closing. And then secondarily, but also important, to make sure there's no sort of risks of loss later because of the seller's poor management of the business prior to acquisition.
And that takes us into perfectly about the compliance due diligence that will occur as well too. You know, not only your procedures, but they're going to be looking at what we talked about in our other panels, you know, privacy and cybersecurity issues. What have the prior exams shown? You know, that's going to be a big issue as well too. You know, that's going to be something that you got to be prepared for. And you got to be prepared to answer that as well too. They're going to ask about insurance. You know, I know we spent a lot of time, Kimberly spent a lot of time talking about cyber insurance. They're certainly going to ask about that, but they're going to ask about other forms of insurance as well too, if you have it. You know, and they're going to be looking to see, you know, what potential claims may be out there. You know, back to the customer complaint file. If you have some issues with customers, they're going to be viewing them as potential litigation. So, you know, that's one of the things that you have to be concerned about. And, you know, that leads us pretty well into the next aspect to it because, you know, the nature of the business, we've talked about this, is assets under management, okay? But what are those assets under management? It's the clients. You know, our worth, and, you know, even as lawyers, we share the same thing that you share. We're only as good as our clients. We're only as successful as our clients. And, you know, one of the things we've talked about before about assignments and everything, and Shelby, if you could jump in too, about client retention and how that all works out and what we should be looking for.
Yeah, so a lot of times these deals will be structured as a separate sign and close transaction, which means the purchase agreement will get signed, and then in between the signing and closing process, this client consent retention process will take place. The client contracts will be analyzed, as our colleagues had described earlier, for what the consent requirements are. Is it affirmative? Is there a possibility that a negative consent will work? And then you know, the parties will come together to put together a communication to go out to the clients and you know, focus on the positives of the deal and try to limit client attrition that way. And in the deals that I've done, I see there, as a condition to closing the transaction, a certain number of received consents, a certain percent. And once that's achieved, the deal can move forward to closing. So that's how I see it working from like a process perspective.
And always remember, you know, as much as it's an M&A transaction, a corporate transaction, you still have the regulatory component, and you have to align the timing, and you have to be understanding that, you know, you may be able to get that, but before you can move forward, you have to have regulatory approval. You know, so what about like retention? What have you seen with that? How does that seem to work, and what happens?
Yeah, so in terms of like retention, client retention, I think it's really, again, because it was a high touch, you know, firm, really just knowing the clients, speaking with them on one-on-one, telling them what's going on, allowing them to feel like they're part of the process, and, you know, really just making them feel like nothing's going to change, especially if, you know, a lot of the main investment advisors, you know, will stay on during the transition process. I think that's really important for client retention to keep them secure. And I'm sure, you know, Shelby, tell me if I'm wrong, but I assume a lot of these deals, there's probably a client retention period where, you know, the folks, the advisors have to stay on and have to ensure that, you know, they're not just going to open up shop across the street and take all the clients with them.
And that's why we're here, because we're going to move into that now about negotiating the terms of the deal. That's perfect.
I think that's good.
Yeah, so to your point there, client retention is largely based on personnel retention. And so there are a number of ways to achieve this, but we see, non-competes have been at risk, you know, recently. They aren't as good as they once were. That being said, they do typically hold up in the sale of a business context. So if you've got a individual seller that is getting substantial sale proceeds, you can use a non-compete in the context of sale of the business. You could get it for 5 years or less. But if you've got key personnel who are not on the cap table, not receiving deal proceeds, it's a little bit trickier. You'll want to build in those sorts of restrictive covenants into employment agreements if you can. Those durations are shorter though, so you can, you know, as a condition to closing, require certain individuals enter into employment agreements that, you know, go for a year or 2 years, just to make sure that we keep clients and keep those personnel, you know, plugged in with the clients. But where non-competes fail as to key personnel, in jurisdictions like California, for example, where non-competes for individuals aren't enforceable, the best thing that a buyer can do in that situation is to make sure that those key personnel are getting compensated very well so that they stick around, and it's worth it in the end if it keeps the clients in place.
What kind of retention bonuses do you find typical versus their annual compensation? Like 2x, 0.5?
So it's sort of all over the map. I can't give a specific range. It depends. So yeah, and then you can also use earn-out mechanisms to, you know, kind of protect a buyer from client attrition. So it's not a transaction bonus, but it sort of keeps the everyone focused and rallied around client retention because they want to achieve their full earn-out after closing.
Yeah, and that also goes to, like, for example, Mark, it goes to, like, for example, if you want to transition into retirement, it's the same thing, that you have to stick around for so many years to earn what you're going to get. Mark?
Good to say, James, we have
an excellent M&A consultant firm that we utilize that gives data on both earnout and retention by industry. It may not be exact to you, but I could get you that. So that's one. Two, for industry-specific BDIA institutions, I have seen scenarios where the acquired entity, the company that wants to be acquired, was being asked to get to certain numbers as a condition precedent to the sale. But be careful if you're considering personnel to do that. One, because they could be key and important to the operations. And also, if an entity has 50 employees, it can avail itself under a federal rule of a mass transfer, which is a very easy way to transfer all of your people. But this one institution had cut its costs by reducing its headcount number from 57 to 43. And now the cost of doing the compliance transfer of all the people became a one-to-one individual cost, and it doubled their compliance cost. And so the acquirer was less interested. They ultimately found another way to work it out, but just be thoughtful when you're thinking about negotiating the terms of the transfer. And they didn't, we came in after this had happened. But it's much easier and simpler to take advantage, I think it's 1017 now under the new rule, to be able to basically take all of your registered people and put them over into the new entity with the mass transfer, but you have to have at least 50 people to do it.
Yeah, and I think the point that Shelby and Mark is saying is that there's no cookie cutter. It's like everything is case specific. Yes.
Well, you specifically mentioned earnouts and incentives. Would you have to describe in the Form ADV what the incentives are, and then be clear about the potential conflict as part of the sale?
That's an interesting question. Mark, what have you seen?
I think that you may have to disclose that those are potential terms of the deal, but FINRA there's been guidance that said that is proprietary, and for the exact terms of this proprietary information to the parties, it doesn't have to be disclosed.
Yeah.
So does FINRA apply, or does the SEC rules apply to RIA?
SEC, but also keep in mind, we've mentioned FINRA a couple of times for a very important purpose. Who runs the IARD system? It's FINRA.
Right.
So it's like we have to acknowledge their existence, even in the RIA space. So but it's SEC guidance as well.
Yeah, right.
SEC guidance as well. Says it's proprietary and not.
Yes.
The formula.
And that's why these consultants that Mark is talking about, that's why they come up with these reports, because they have some information that they can share. Yes.
So a couple of comments. Number one, FINRA has long plans, and they've attempted on numerous occasions to be the SRO for RIAs. They're not there yet, but they definitely shown interest in that. On a separate comment, I find that sometimes if the employment agreements don't stipulate a anti-compete or whatnot, if the people really don't like the PE or the investor or the new owner, then they're not going to stay. And with the clients, you can't make them stay either. Even if they're poach or not poach, some people say, hey, I'm with this guy, and if this guy leaves, I want to be with that guy. So it's not even a question of somebody trying to poach a client, although I think that's a consideration as well. I guess my question for Shelby is, what do you offer as consideration for people to stay when they really don't want to, or whatnot, if that's not clearly spelled out in their employment agreement?
Yeah, so that's a risk that you have to take. And so to try to mitigate against that, you want to negotiate for an earnout that is achievable, even if you could stand to lose some and still achieve your earnout, right? Like, you've got to base the earnout on controllable metrics as much as possible. And then, it's not 100%. So you want to just try to make sure that even if you've got some transition hiccups, that you can still try to achieve an earnout.
Yeah, I think the other consideration is that people want to know that the new owner is going to be around for a while, that they're not going to just pull their money and have the RIA fold because they can't make it work. So, that's going to make clients seem uneasy if they're not sure that they have confidence in the PE.
Yeah, and one of the other things that we're seeing is that one of the things that will happen is that, look, the the CEO, we'll just give them that title, may want to move, may want to do something to, engage in this type of planning, while they may have about a half a dozen people underneath them who have access to significant assets of the building, the billings and the clientele. And they may view this, nothing personal, but they may view this as an opportunity for them to spread their wings and do something else. And there may not be a way to retain those people. That's something that you have to consider as you're that happened with a client of mine where, they wanted to sort of transition, but they had a bunch of people that they thought were family, and then all of a sudden, one of the family members, one of the prodigal sons, decides that they want to do something else. They took a significant portion of the business.
And then isn't there a big risk with, especially if you're dealing with ultra high net worth, who everyone seems to want these days, it gets out that they're doing a sale and then your competitors are over. I mean, to me, that's huge. And then they're not only talking to possibly, if they know those clients, but also those employees before you have any kind of contract.
Sorry, I was going to say two things with respect to high net worth. I think that's why it's key that part of that buyers are going to want some sort of transition plan where the key players, key advisors are still there, point of contact and their daily, advisor. So the transition, there's always a transition plan. And in terms of retention of employees, they're big payouts. They're, folks that were making $200,000 and got $1.5 million bonus checks to stay. So, if there's an investment advisor that is generating a solid income, I think buyers are willing to pay to keep talent.
I assume your firm represents buyers and sellers.
Yes, we do both.
So I worked in-house and I used to coach up our sales team as to when one of our competitors was selling the firm, how our team might go get those clients.
Exactly.
And we had a lot of fun with that. We had a big board on the wall. We knew the names of the people, and I would just coach up the team about the tactics. Don't lie. Don't say Jerry was a bad employee. Just say you ought to leave the assets here.
And that leads us into our next topic about what are the considerations that buyers and sellers should have, when they're looking at this, when they're looking at these types of deals. Shelby, you want to begin with that?
Yeah, so kind of some practical guidance for buyers is, front load the compliance stuff, have a plan for assessing that from a diligence perspective, design earnouts that make sense, that are unlikely to end up with disputes in the end, base them on controllable metrics, avoid incentives that jeopardize fiduciary duties. And then, like Sahar said, an integration plan is key. Make a checklist, assign owners, timelines, KPIs across various, sections of the business: compliance, operations, finance, IT, HR. And then, like we're talking about, make sure advisor compensation is very thoughtfully considered, since it's so important. Make sure your client outreach is warm and thoughtful, and coordinate with custodians. Make sure you've got a plan for data migration, which is also can be quite the effort. And then on the sell side, come to the table ready, come to the table organized with your contracts, with your business information, your finance information ready to go to present to a buyer. If you come to the table ready and organized, you're going to be much more likely to get a better multiple. And, present professionally, build a deal team. These deals can take on, it ends up being a full-time job just to manage the deal. And so while there's active business that needs to be done day to day, if you've got a dedicated deal team on the sell side ready to react to a buyer's diligence requests and negotiating the purchase agreement, those things are going to make the process a lot more smooth if you've got this sort of pre-thought as you approach the deal table.
And to add what Shelby is saying, I'll start with the seller side. Please keep in mind that you got to get your house in order. And I know all of you have your house in order, but it's a good opportunity to review again, because we could all improve. And making sure that everything is ready to go, your agreements, as Shelby was saying, your manuals, your customer agreements are up to date. everything is out there, because having all of that in place mitigates the risk that a buyer is looking at when they're assessing how much they're going to pay. And as for the buyer, look, it's the questions that we've been getting, which is like how much are they going to pay? How much are they going to look at? And for a buyer has to look critically at the metrics of the seller, not just the financials, but the more like amorphous things, like like one of the great scenes in movie history was, especially for our field, was the movie Working Girl. Remember, with Melanie Griffith and Harrison Ford? It's towards the end of the movie when Melanie Griffith is found out that she's only an assistant. You're not allowed to use the word secretary anymore. Only an assistant, and not an investment banker. And she gets pulled into an elevator with one of the deal guys and Harrison Ford, and he asks her, "Okay, how did you come up with this transaction?" He begins to say, and then they confront her boss, Sigourney Weaver, who has no idea, even though she was trying to take credit for the deal. And they fire Sigourney Weaver and they hire Melanie Griffith in true Hollywood fashion. But the point that I'm getting at is, with buyers, you want to lock down. And part of that other thing was that it was a radio transaction. They were buying radio stations, and the top radio guy, his contract was ending, and they decided that they had to lock in that contract. Those are the things the buyer has to ask about, about those, not only about the money, not only about what the company is earning, but about the underlying aspects of that firm before making a legitimate offer. Look, last war story, I've had clients complain to me about, their firm is doing gangbusters. They're bringing in all this revenue. Why are they getting these bad bids? Well, when you look at the underlying metrics of your firm, you've had some issues with some customers in the past. You've had some other points that have popped up. You've had to take some charges and things like that, some settlements, some regulatory dings that went along the way. That's going to influence a buyer. Sarah?
I was going to say, and also just street cred, right? Reputation, so just keeping a clean and honest reputation goes a long way.
And yes.
Yeah, and other than Ernest showing his age there, I mean, they're going to ask you.
It's a classic. It's like everything else. You can watch it anytime.
Of course, I'm sure you do. All that being said, I mean, down to the nitty-gritty, they're going to ask you your compliance manuals, all your manuals, and when they were last updated. You're going to want to see even your tax returns, because your manuals may be fine, but if you're going to lie to the IRS, well, that's a different story. So everything's got to sync, and asking for all your regulatory reports, inquiries, examinations, special purpose exams, are going to ask for all that. They're going to pick apart every aspect of that. So everything's got to be up to date. And, what I do is I usually use an outside party to review manuals every few years, because A, you might not have the time to do it, and B, keeps Ernest in business, and C, they do a great job.
And
having the independent view is
right?
great.
There's regulatory changes all the time.
Yeah.
So,
and no offense to Ernest here, but if they cite you after you've done this review, you can play the lawyer card and say, yep, I was proactive, I went on the outside, I didn't take it, and then this thing will be less depending on the materiality of the item.
Yeah.
And
there's nothing wrong with throwing the lawyer under the bus. I advise clients to do that all the time. Yes.
I was struck by your California example where that asset flipped several times, and then your question about things to look for. The one thing that I've found over the years that is often underappreciated is cultural alignment and your values. And I'm going to share an example very quickly.
Take your time.
Point estimate, you mentioned a PE. Another way to think about valuation is that multi-year period, that resiliency. If you have the cultural alignment, and it could be things like, personal accountability, engagement, transparency, investors will pay a premium for predictability. So anyway, it was just I've seen so much M&A over the years, and I've seen asset write-downs, and then your California example it really resonated.
It's like the old expression. It's just like the old expression. The street loves nothing more than certainty.
And I was going to say, just in terms of just alongside what you're saying, everybody who could stay, stayed because it was an awesome place to work, right? So, of course, not only are they compensated well, but it was just a great place, a great environment. So,
one of the last topics we want to talk about is it's funny, the two big questions we always get are price and timeline. So, Shelby, when you're doing one of these deals, what do you tell people about timeline?
So typically a deal can take, I've seen deals take a year. I've seen deals take place in 30 to 60 days. I think the latter is more common, 60, 90 days. Usually you'll start with an LOI, a pretty high level summary of the key terms will show up. You'll decide as the seller whether or not you want it, sign it, and then the buyer will proceed into due diligence. Due diligence will take place for a while, and then at a certain point, the purchase agreement negotiations pick up while diligence trails off. The purchase agreement gets negotiated for a while, and as I mentioned before, a lot of these deals end up being a separate sign and close. So you'll have the purchase agreement signed, and then a period of time between signing and closing to deal with the client consent mechanics mostly, other things too, but that's sort of the primary driver. And then you'll close and then move into sort of the integration process, the earn-out period, which can take 2 years, 5 years. I've seen them all sorts of duration, but sort of the 2 to 5 year range is what I more typically see. And that's sort of the kind of beginning to end process as I see it, Ernie.
I have a question. I was just going to ask you, Shelby, have you ever seen situations where the deals haven't gone through after the LOI is signed? And what are the more common reasons that deals have
on top of that
down?
You see breakage fees if the deal doesn't go through on top of that.
So the break fees I find less common, at least in the deals that I do, because they're on the smaller side most of the time. But the larger transactions may support a break fee. But typically, an LOI will get signed, and as you all know, those are non-binding. And so if the parties decide, the buyer decides, there's too much risk here, the compliance isn't what we want, the business case didn't prove out, then they'll abandon the transaction and delete all of the diligence materials collected and move on. But sometimes it's not just a diligence problem that causes the transaction not to go through. It's sort of the parties reach an impasse in negotiating the purchase agreement where the buyer is asking for things that the seller doesn't feel like they can deliver or are not palatable. From a purchase price and earnout perspective or from a governance perspective. A lot of these transactions, as we mentioned earlier, are the seller will retain ownership or either minority or majority. And so sometimes those governance negotiations are where things get tricky because an advisor doesn't really want to give up control or isn't able to, tolerate what the buyer or the PE is asking for as far as, governance control after closing.
And basically, there are times when, you may have had a great introduction, got to the LOI, but then as you're going through the process, you find out you really don't like each other. You're not going to be a good fit. And, that's why sometimes deals don't happen. It's not something that you can point your finger at and say, oh no, there's this underlying liability that we don't want, or you're being too cheap, you're not giving enough money. It's just that they find out, no, not for us. And so it sounds like in that situation, they kept selling it back. It just wasn't us.
Well, they just couldn't run it.
Yeah,
right?
they couldn't run it.
So the key is to, I guess, really know your clients well and become their, very close friends. And maybe you can just keep buying back your business for pennies. So, pretty remarkable story.
Yeah, and look, timing is like everything else. It's consistent with what we've been saying throughout the course of this talk and everything, that it's deal specific, and the more I will say one thing, it's been my experience, and some people may disagree with me on this, it's been my experience that the smaller the amount of assets under management that are being purchased seem to engender the more difficult set of negotiations. That's just been my experience. And meaning that, like, if you have, it's almost like if you have like $500 million under management, that's an easier negotiation than, like, say, $50 million. It's one of those things which pops up. I'm just letting you know about that.
It's also because, I'm sorry. sorry, I would think that the smaller firms have oftentimes that a lot of the things like we were talking about are calculated manually rather than, so it becomes a much, that's what I totally expect. Like just like huge acquisitions like JP Morgan Chase.
Yeah.
They take a lot less time because they know exactly what they're looking for and they immediately are like, this smells, goodbye.
No,
So I think like the really small ones are much more complicated.
I think it's based on materiality, right? So like if a deal is huge, some active litigation is a drop in the bucket potentially. But for the smaller deals, everything is much more material. And so one issue could be a deal killer, whereas for a larger transaction, it's just sort of a, we'll deal with it later kind of thing.
I also think it goes to the culture aspects, the governance aspects that we've also been mentioning that also create that issue as well too. It's a little different when you're running your own shop in a smaller RIA and someone comes to you and says they want to do A, B, and C. It's more of a culture shock and you have to be comfortable with that. I think that's what it comes down to too. On that note, we're going to move to closing remarks. And I'm going to do something different. I'm going to start with Sahir first. So what would you tell people like buyers and sellers? Like one thing,
I mean, I would say definitely, again, the same thing I just said for sellers. I think a lot of it comes down to just, really having those genuine relationships with your clients and your employees. That good faith really goes a long way when it comes to selling your business. And on the flip side, for buyers, I really think a lot of it comes down to compliance governance, at least from my perspective, because, an advisor that's very organized, very clean, has all their ducks in a row, follows a very specific compliance calendar, can show documents, for following all of the rules and regulations is a lot sexier than, something that's just a little bit disorganized, not as clean, not as transparent. So those are my two suggestions.
Shelby?
Yeah, so I'd echo that too. Just, having great relationships with your clients and your employees is key. But as a seller, like I said before, show up organized, show up with your ducks in a row and understand what a buyer cares about. From the buyer side of things, I think integration is most important, and focusing on client retention efforts between signing and closing and after are critical for having a successful deal.
And I just to echo those comments and to put a fine point on it, it's like Boys and Girl Scouts, their mottos: be prepared, be prepared, be prepared. Always be available in terms of, getting things done. And the earlier you can get things done, the better. So with that, our panel comes to an end. And I just want to thank Shelby and Sahir especially Sahir for jumping in like this. And Shelby doing such an amazing job. She deserves it just for the travel issues, okay? It also comes to the end of our program as well, too. We just want to thank everyone for being here today. Please stay in touch. Contact Sahir, Shelby, Kimberly, Mark, everybody who was presenting today. They're more than happy to take your phone calls or your emails. Our contact information will be provided to you in an email thanking you for attending, along with the PowerPoint presentation. And we're here for you. We're here to help in this process. It's a slog, but we can work through it with you. Thank you again for attending. Appreciate it.